go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working with that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick. It's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 2 p.m. on Wall Street, and stocks are trading mixed as the market digests and assesses some data on wholesale inflation. From Bloomberg World Headquarters in New York, I'm Doug Krisner. Producer prices up just 0.2% last month. That's about half of what the market was expecting. Importantly, food and energy prices were down. They had been primary drivers of inflationary pressures last year. But this tame reading on inflation has really not shifted the conversation when it comes to interest rates. At her confirmation hearing today, Fed Governor Lael Brainerd said tackling inflation is the most important task.
Inflation is too high, and working people around the country are concerned about how far their paychecks will go. Our monetary policy is focused on getting inflation back down to 2% while sustaining a recovery that includes everyone. This is our most important task.
Also today, we heard from the president of the Philly Fed Bank, Pat Harker, who was saying he favors a March liftoff and 3 to 4 rate hikes for 2022. Even so, long-term interest rates drifting lower, a 10-year Treasury at 1.71%. Now, in the equity space, the Dow is ahead by 0.2%, but in the broader market, it's weak technology shares leading the S&P lower by about 0.5%, and the NASDAQ composite right now weaker by 1.3%. Shares in Delta Airlines higher, even though the company says that it will contribute to will see a first quarter loss. Delta is still saying that the virus is not going to derail expectations that it will remain profitable for the remainder of the year. And cruise line shares are trading higher for a second session. It was on Tuesday. CDC Director Rochelle Walensky was saying measures to curb virus outbreaks will likely expire as planned on January 15th. We have shares in Carnival Corp right now up by more than 4%. The dollar showing a little bit of weakness with the Bloomberg Dollar Spot Index down about 0.1%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, it's Friday's Eve. Gosh, I'm ready for Friday. I don't know about you. It is Thursday, January 13th, 2022, live in our Bloomberg Interactive Brokers studio. We're streaming on YouTube, and Tim Stanovic's off, a Bloomberg News cross-asset reporter and co-host over at Quick Take. Katie Greifeld is somewhere in our New York office. Where are you?
I feel like I'm about 50 feet from you. And if this virus has proven anything, it's that we can be very creative and think on our feet.
And right, we're constantly dealing with it, which is a good reminder for all the stories that we're going to cover over the next few hours. We're going to talk about the markets. We see some pressure on tech stocks once again, despite a report that suggests an easing of inflation. We'll get to that, Katie, more in just a moment. And then top of mind, we've got the Goldman trading desk. Did you see this story?
Yeah, this was a really interesting one because you don't hear a lot about actual bank, trading desks anymore.
No, exactly. But it sounds like I think the headline on is that they're minting money. So we'll get to that. It's also a Bloomberg exclusive. We're going to talk about the employee morale at Meta, not so hot. And then we're going to check in with the folks over at Microsoft 365. They see so much, tons of data points, Katie, and it really gets into how we work. First up, though, let's get to the Market Drivers Report. And let's set the Business Week agenda on this Friday's Eve. Kriti Gupta with us, Bloomberg Markets correspondent at Bloomberg News. She, too, somewhere in our New York City bureau. And then Michael McKee, international economics and policy correspondent, here next to me. He apparently made the clearance.
I'm not breathing. They told me I could come in, but I can't breathe.
Mike and I are being very careful. Mike, I do want to start with you. It's been a big week, certainly on the Fed front. You've been busy, and I have to say, every time I see you pop up on Bloomberg TV, I listen in because I want to know what the latest Fed folks are saying and what the economic data says. We got another drop today in terms of data points.
Well, the PPI came in and on a monthly basis was significantly better. The final demand PPI in November was up by 1%. It was only up by 0.2% in December. But that's because oil prices fell and we had some commodity prices drop. And if you look, they're all going back up again. So you can't take a lot of comfort in that, and it basically just tells you that inflation is still an issue. Now, it may be peaking now or in the next month or so, according to a lot of experts, but it is still there. So that's driving the Fed activity. Today we had Lael Brainerd go up to Capitol Hill for her nomination hearing to be vice chair of the Fed, and she joined the chorus and said, we're going to raise rates a couple times this year.
She hopped on the bus?
She hopped on the bus. She basically hinted that they could start in March, because she said, we can start as soon as the tapering is done. And the tapering's done in March.
Yeah, Mike, and I mean, how surprising is it to hear her hop on the bus? Because I remember when people were still thinking that, maybe she'd get the nominee for Fed chair, that, the message was that, oh, she's very, very dovish. But now it seems like, she is, singing the party line.
Well, as they say, 7% inflation, sort of like getting hit in the head by a 2x4. It's got their attention down at the Fed, and they know they need to do something. And so there's really no debate about this. When you count up the number of Fed officials who've said over the last week that we need to raise rates 3 times, and a couple saying 4, and about 5 of them now are on board with March. So I think it's pretty much a done deal, which is fine, because now the markets have already had this chance to adjust, because the Fed has guided them in that direction, and nobody seems too upset about it.
All right, Katie, come on, Creedy, come on in on here on the market trade today, because we're seeing once again tech names in particular under pressure.
Yeah, absolutely. That tech underperformance is going to be crucial. It's weighing on the S&P 500, it's weighing on the NASDAQ. You are seeing these kind of reflationary bets, essentially a little bit of deja vu from the start of 2021, where you had all these value bets kind of come back to the forefront, whether it's those kind of economically sensitive stocks, energy, materials, industrials, but then also seeing like the Dow outperform. And then you see that cross asset too, emerging market stocks, commodities as well. And I think the big takeaway, the one kind of driver of all of this, is the fact that you're seeing some of those haven flows come out. You're seeing it in tech. You're seeing it in the dollar as well, which is kind of echoing across the asset class. The question here is this just a little bit of kind of beginning of the year repositioning, or is this perhaps the start of a turnaround that would mean value actually outperforms growth after 15 years of underperforming?
And I mean, what happened to the dip buyers? Because I feel like we saw some dip buying of biblical proportion earlier this week.
They're somewhere in our New York City bureau.
Right. I guess they're also trying to find a spot amid whatever's going on with COVID. But what happened to them? What happened to that bid? It feels like it just evaporated.
Yeah, well, we got to talk about who the dip buyers actually were, right? Because if you compare this to, say, the dip buyers when you were looking at the onset of the Omicron variant headlines, or even the onset of the Delta variant headlines, where you saw similar price action, this kind of big sell-off, a lot of the dip buyers were retail buyers, actually. They weren't necessarily institutional. This time you're seeing a lot of the selling, and I believe your team, Katie, actually wrote the stories that covered this. The hedge funds were the ones that were driving the selling. So the better question is, are hedge funds coming back? And that's going to be, if they do come back, they're going to come back in kind of much larger proportion. So I bet they're waiting a little bit for a little bit more of the kind of froth to come out before diving back in. They want those better margins.
Yeah, want even a better deal when it comes to tapping in. Hey, Mike, we got a retail sales report tomorrow. Do we care?
Yes and no. I mean, we want to see how things went, but it's going to be kind of interesting, because this is one report that is going to show an Omicron effect, because the retail sales report in theory covers the month, although it's mostly about sales in the beginning of the month. But we did see gasoline prices go up and car sales go down because you couldn't get cars to sell.
Right.
Beyond that, though, it was very strong, according to those people like MasterCard who tally up what people spent. So the core stuff, the stuff you bought as gifts for people, is probably going to be very strong. But also, there's a lot of inflation, as we mentioned before, and they calculate this in dollar value. So it'll be higher than the number of things you bought.
All right, we got to run. Mike, thank you so much. Michael McKee, international economics and policy correspondent here at Bloomberg, and Kriti Gupta will be back with her chart of the day. Let's get to the Bloomberg Business Week Bite of the Day. One number that tells us a lot. Today's number, 846,000. BMW posting record annual sales in China, delivering more than 846,000 BMW and Mini cars in 2021 with its Chinese partners. That is up 9% from the previous year. Sales of new energy vehicles, meantime, surging 70% to around 48,000 units. All right, we're just getting started on this Thursday. Let's get a check on world and national news. Over to Nancy Lyons in D.C. Hey, Nance.
Thanks,
Thanks, Carol. President Joe Biden says with the Omicron variant of the coronavirus surging, his administration will double its order of rapid COVID tests to send out to Americans.
I mean, 1 billion tests in total. And we'll continue to work with the retailers and online retailers to increase availability.
Biden says his administration will also be distributing high-quality masks to the public. He admits masks are a pain in the neck, but he calls them absolutely necessary. Details for requesting the supplies will be released sometime in the next week. There may be new life for nuclear power on Capitol Hill with an unexpected ally. Bloomberg's Amy Morris reports.
Senator Joe Manchin from coal-rich West Virginia says he wants to expand a tax credit for nuclear power plants in the Build Back Better plan. Under the version passed by the House, a credit of as much as $15 per megawatt hour would be claimed for the next 6 years. Sources tell Bloomberg Manchin wants to expand that to 10 years, but that would also mean increasing its price tag. That's a challenge, as Manchin also wants the administration to scale back the $2 trillion spending package. In Washington, I'm Amy Morris, Bloomberg Radio.
Navient, one of the nation's largest student loan servicers, has agreed to a big settlement. The company that used to be called Sallie Mae says it will provide relief totaling nearly $2 billion to resolve allegations that it used abusive and unfair student loan practices. Navient was accused of steering struggling students into costly long-term loans instead of more affordable repayment plans. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, my co-host Tim Stanovic, is off. He also happens to be Katie Greifeld's co-host as well. He kind of gets around Tim Stanovic, doesn't he?
We share him. We share him.
You get him for weekends, or I get him for weekends. You get him for the week. Tim, we love you. Tim, we miss you. But Katie's here with me for the next couple of days. Hey, there's a couple of stories on the Bloomberg about some of the financial firms, what they're doing right now with bringing workers back to work. Goldman postponing it a bit.
Yeah, this is interesting. So it's delaying its return to office for staff in the U.S. by another 2 weeks. Remember, it had to backtrack last month because Goldman really has been pushing to get its employees in particular back to the office, emerged as a champion of sorts, but just haven't been able to actually do that. I mean, with all these different variants coming about.
Yeah, exactly. And they say anyone entering the bank offices must get a booster by February 1st if they're eligible for the injections by that date. So we are increasingly saying firms say, like, get those shots. In the meantime, a story on Blackstone as well, requiring their U.S. staff to get COVID-19 booster shots to work in the office. So they, again, are jumping on that bus in terms of stepping up pressure on their workforces in recent days to get jabs and take more tests. We are increasingly seeing, right, one pile on the other, especially in the financial community.
Yeah, for sure. Like you said, the financial community, it feels like they're all taking their cues from each other, really. It'll be interesting to see if anyone follows Citigroup's route. Remember, we had a Bloomberg News story, I think it was last week. Time just bleeds together, but that story threatening unvaccinated employees with termination. I feel like that's the most aggressive bank policy I've seen yet, but seems like boosters, you got to get a booster. That's currently the lay of the land.
Yeah, absolutely. We're seeing this increasingly. And that Citigroup story, that really kind of caught all of our attention. And I think a lot of their people were vaccinated already, but basically, I guess, to some of the outliers, I am curious to, Katie, what kind of commentary we're going to get. The big banks, JP Morgan and others, starting to report tomorrow, so we'll see what they get on this front. You're listening to Bloomberg Business Week. Carol Masser, Katie Greifeld, and this is Bloomberg Radio.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Stocks are trading mixed right now as the market assesses data on wholesale inflation. Producer prices last month up just 0.2%, half of what the market was expecting. But this really has not shifted the conversation on interest rates. At her confirmation hearing today, Fed Governor Lael Brainerd was saying tackling inflation is the most important task. And the president of the Philly Fed Bank, Pat Harker, was saying he favors March liftoff and 3 or 4 rate hikes this year. In spite of these comments, which may be construed as a little hawkish, yields have pulled in a little bit. 10-year Treasury down nearly 3 basis points. Now we're at 171. And the yield on the 2-year at 89 basis points. It's down about, let's call it 2 basis points. Now, in terms of the outlook, well, clients at Morgan Stanley are expecting financials to outperform this year. A survey conducted at Morgan Stanley's annual conference shows 45% of respondents are betting the financial industry will be the best performer this year. Tomorrow we'll get earnings from Wells Fargo, Citigroup, and JP Morgan. Keep your eye on loan growth figures. Today, the KBW index is up about 0.8%. In the currency market right now, more dollar weakness with the Bloomberg Dollar Spot Index down 0.1%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Doug, those big banks already an outperformer. I mean, KBW is up like 12% this year.
All right.
All right, I'll get off my soapbox. Thank you, Doug Krisner. You're listening to Bloomberg Business Week. Carol Master, Katie Greifeld in for Tim Stenovec. Hey, Katie, some of the headlines that we saw when it comes to COVID today, the President Biden coming out saying his administration will double its order of rapid tests to send to Americans while also distributing high-quality masks to help fight a surge of cases of the Omicron variant, right? That's something I know Mike and I were just talking about, the quality of masks. It's a difference. It matters.
Yeah, in my life, I mean, I would love to get my hands on one of those masks, but I'm trying to order them off of Amazon, and it's that's a chunk of change.
Yeah, it's a chunk of change if you can get them. Hey, let's see what he is seeing when it comes to the latest headlines. By the way, China detecting Omicron in a second major port city, so we continue to see outbreaks certainly around the world, and for them, it's tougher ahead of those Olympics. Dr. Andy Pekash is back with us, professor of molecular microbiology and immunology at Johns Hopkins University, Bloomberg School of Public Health, of course, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. He joins us once again on the phone from Baltimore. Dr. Pekash, good to have you back here on Bloomberg with Katie and myself. How are you, and what's the latest from your perspective and the headlines that we really need to be paying attention to?
Well, you can see that the case surges with Omicron are still at unfathomably high levels. I know there's some parts of the country that are hoping to see a plateau, but at the end of the day, we are at such a high level of cases that even if things started to go down, we would be at high levels of cases for a week or maybe even more. So it's really a matter of dealing with the surge that's ongoing right now and dealing with it with the lack of certain essential things that we need, like you were mentioning before, testing and various other things.
And doctor, I mean, it seems like the narrative around the Omicron variant is that it's less severe. You're going to get sick, but maybe it's, equivalent to the common cold. I know that hasn't been the case for everyone. But, my dad has been joking for weeks that he doesn't want to get Omicron. He wants to get the variant that comes after Omicron because it feels like it's been getting less and less severe. But does the science actually work that way? I mean, should we believe that the next variant that comes along will be even milder?
Yeah, no. Unfortunately, the science doesn't suggest how COVID-19 disease is going to change in the future. I think even with Omicron, if you're unvaccinated, I would be very concerned about getting infected with Omicron if you were unvaccinated, because those are the people that are in the hospital right now that still represent the majority of people with the severe disease. For the rest of the population, particularly because of our immunity that we have from vaccines, those vaccine-induced immunity doesn't protect us from infection, but it is lessening disease severity, lessening symptoms. It's very similar to what we talk about on an annual basis with influenza vaccines. The vaccines are now not preventing infection as efficiently as we maybe would like them, but they really are protecting against severe disease and quickening the course of the infection in individuals.
So When you look into your crystal ball, I'm curious, we keep thinking, all right, it does feel like certainly better than where we were a year ago, but it still is staggering to think we are in year 3 of this. Dr. Prakash, I guess I'm trying to get my head around that. Will I always probably be living in a world with COVID, but will it get to a point where I look at COVID just like a case of the flu? And I shouldn't say just, because the common flu every year kills thousands of people too, right?
Absolutely. But I think if there is a sort of a silver lining here, it's clear that people who are vaccinated and who have subsequently gotten infected have an amazingly strong immune response that's not only very high, but it's also broad, meaning that it recognizes lots of different variants that have been through the population already. So this combination of vaccination and infection is going to put us at a place where severe disease for at least most of the population is going to be somewhat unlikely. We'll need boosters periodically to maintain that. My real worry, though, is, we really don't know about the high-risk population. So we know the elderly are more predisposed to severe disease. We know there's certain medical conditions that make you predisposed to severe disease. Those are the populations we're really going to have to keep an eye on as we go forward, because we want to make sure that we're protecting them as well as much as we're protecting the healthy part of the population.
And Doctor, we don't have much time left, but I would love to hear your perspective on tests, because, just in my own personal life, I've heard some mistrust about rapid tests, that, they're kind of faulty, that the PCR is the gold standard. That's what you got to get. What do you think?
Rapid tests work particularly when you're showing symptoms, and so they'll help you know if you're infected with COVID-19 or if with something else. Given the test shortage, though, I think a simple thing to remind people of is if you've got some sort of respiratory symptoms, stay home, period. If you're infected, you may be infected with COVID, you may be infected with flu, you may be infected with something. So if you don't have access to a test, just keep the simple, basic principles of if you're feeling ill, stay away, use the rapid antigen tests if you have them when you're symptomatic, and then always with a positive rapid antigen test, confirm that with a PCR test, because that means you have COVID and you need to get your numbers into the public health monitoring system.
All right. We always appreciate time with you. Dr. Andy Prakash, he's professor of molecular microbiology and immunology at Johns Hopkins University, Bloomberg School of Public Health. And of course, as we mentioned, it is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Katie, real quickly, you can call your dad.
I hope he was listening, because that was some good information there.
We're going to send him the podcast. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yeah, this is Bloomberg Business Week, and it's Thursday. I'm Carol Master along with Katie Greifeld on this Friday's Eve. Hey, two of the most read stories on the Bloomberg in the past 8 hours, two of the top 10 have to do with, actually, I think it's three, Goldman Sachs.
You know, terminal readers, they love to read about Goldman, especially when it involves billions of dollars, I feel like.
Oh, my God, especially when you're minting those billions, right? Like, it's like a never-ending. Anyway, we're going to get to this story in just a moment. This comes ahead of those big bank earnings, which start tomorrow. First up, though, back to Doug Krisner with a check on that trading day. Hey, Doug.
Hey, you caught me minting billions. It's a mixed picture for stocks right now, Carol. I'm going to say that the Dow now is flat, but the S&P, given some tech weakness, is slumping by about 0.8%. NASDAQ composite weaker by about 1.6%. The day began with word on wholesale inflation moderating, PPI rising just 0.2% last month. That's about half of what the market was expecting. It's really not changed the conversation, though, when it comes to interest rates. In fact, long rates are actually drifting a bit lower, with the 10-year Treasury now down about 3 basis points at 171. We heard today from the president of the Philly Fed Bank, Pat Harker. He was saying he favors a March liftoff and maybe 3 or 4 rate hikes this year. So it seems as though the market is already baking this into the cake, so to speak. Interesting price action in Taiwan Semiconductor, the company overnight raising its growth projections, also unveiling plans for record cap spending this year. Taiwan Semi ADRs here in New York up about 6.8%, but other chip makers are trending lower. In fact, the Philadelphia Semiconductor Index now is down about 1.3%. Want to quickly touch on Delta Airlines, the company saying the worst of Omicron is behind us. The company is still going to have a first quarter loss, but Delta is confident that the virus is not going to derail plans to remain profitable for the remainder of the year. Delta shares right now up nearly 3.5%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Got it. Thank you so much, Doug. Well, Katie, we talked about it. There's a bunch of Goldman stories on the Bloomberg that are catching people's attention. Mm-hmm. I love the headline about the Goldman trading desk. We haven't gotten their earnings yet, but they're giving us a little bit of a preview, I think.
Yeah, absolutely. And this is interesting because it's about commodities, which I know we're about to get into, but feels like the bright spot for so long has been fixed income, but I don't know. We'll see. Maybe the leadership is changing.
Yeah, that's a really, really good point. We're going to get into that with our own Sri Natarajan. He's finance reporter at Bloomberg News. He's on the phone in New York City. Sri, great to have you here with us. We mentioned a most read. It's a Bloomberg exclusive about their trading desk, their commodities trading desk. What's going on?
Carol, it's truly a window into the kind of success that Wall Street trading operations have seen in the last 2 years. The Goldman Commodities business is expected to post the best performance in over a decade. And that mirrors the kind of excess and success you've seen at Goldman Sachs and other banks. But it is a little more special than that. At Goldman Sachs, the commodities business does have pride of place. It was the business from which you had senior leaders who went on to run trading, investment management, HR, and even all of the firms, including President and CEO Lloyd Blankfein and Gary Cohn, all came through the commodities business. And in 2017 through 2016, 17, 18, there was a real worry that the business was in serious decline, mirroring what people felt was a secular decline in trading across Wall Street. But much like everything else that these businesses have touched since the onset of the pandemic, you have seen a remarkable turnaround in the fortune, and commodities is just a microcosm of that.
And so I love the headline that this trading desk, the commodities desk, it dodged the axe, minting billions again. But I mean, it feels very fickle that obviously we've seen a ton of just chaos almost in the energy markets. But I mean, could the axe come again when things inevitably slow down? Or does the fact that they are so profitable right now, does that buy them time?
Yeah, Katie, you're absolutely right about the whole idea of it being fickle, because remember, when it was at its lowest point in 2017, the business was pulling in revenue that was less than 10% of what it would normally do in its best years. there were serious worries. And at that time, a firm like Goldman Sachs was also having a leadership transition where instead of the traders who ruled the firm, you had a bunch of advisory bankers suddenly rising to the top. And when those people look at a business like a commodities trading desk, they see something that's scary, complicated, and volatile that sucks up way too much capital, paltry revenues, and return on equities that would antagonize and scare away a lot of shareholders. But those who wanted to stick it out and those who wanted to keep the business made the point that it is counter-cyclical in nature. It has its best years and moments of turbulence. The best performances for that desk was it's sort of in the 2007, 8, 9, 10 period when not a lot of other things were going great in finance. And now, since the onset of the pandemic, when you have negative oil prices and then shooting back up to $80, you have power grid failures in the U.S., frenzied price action in the European gas and power markets. When you have a business that is able to participate in all those price moves, they will come out looking good. And that's what Goldman Sachs has done.
What are the longer term implications of this, Shri, in terms of, I'm thinking of other firms who are looking at this. I mean, I don't know, what changes, if anything?
Much like we talked about how the commodities business is a microcosm of what's happening across all of trading, it's also a window into what the commodities business itself is looking like. Goldman's in-house analyst, Jeff Curry, a widely followed voice in energy markets, came out and said that, we're entering another super cycle that could last another decade. Jeff Curry first rose to prominence in the mid-2000s when he called a bull market that was going to be in place and last for a while because of the China-driven boom. And he forecast oil prices going above $100. He was right. Ultimately, it went up to about $140. And when he says that this period of a lot of interesting price action will continue to take place for over a decade, you wouldn't be surprised if suddenly a lot of other banks are thinking about beefing up their trading operations, trying to become more visible. You have to be committed and you have to be certain you want to take the plunge because there will be a lot of costs associated with the business and a lot of capital charges. So you better be prepared to guts it out. But the rewards can be plenty and pretty if you end up on top of the pile.
And Shri, we have just about 40 seconds, but I am curious. I mentioned fixed income trading. That had been the bright spot, it felt like, through the pandemic. But we got those Jefferies results yesterday. You saw a big drop off there, at least for this quarter. I mean, are the energy traders expected to be the all-stars?
Look, the energy trading desk sits within fixed income, and when the Jefferies fixed income numbers came through, you saw what happened. They posted a slowdown in the FIG business, and the shares at one point were down 10% for the day. So when the banks report earnings over the next week, it will be a tale of two halves. Everyone will look at a rearview mirror and will be very pleased with how they performed. They will be extremely keen to hear their forecasts and predictions for what lies ahead, because that's what is really going to affect the stock price movement. They want to see if that ebullient action that we've seen over the last 12 months can stay in place, or we're awaiting a slowdown.
All right, good stuff. As I mentioned, there's like 3 stories among the top 10 on the Bloomberg, among the most read, and that includes Shri's exclusive. Shri Natarajan, finance reporter at Bloomberg News with the latest on Goldman Sachs. Stock up about 0.5% today. All right, back to world and national news. Back to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. The Supreme Court has blocked part of President Biden's guidance on dealing with the pandemic. The justices blocked the vaccine or test rule for large U.S. businesses, but it is allowing the vaccine mandate for most healthcare workers. President Biden is taking additional measures to combat the virus, which continues its severe impact on the unvaccinated and the hospitals that treat them.
The president said 1/3 of Americans are ignoring the guidance to wear a face mask indoors, so masks will soon be made available free of charge. In addition,
I'm announcing our next deployment of 6 additional federal medical teams, a total of more than 120 military medical personnel to 6 hard-hit states. I'm directing my team to procure an additional 500 million tests to distribute for free. I mean, 1 billion tests in total.
the president again pleaded with social media to screen out COVID disinformation. In Washington, Irv Chapman, Bloomberg Radio.
President Biden has been spending part of his afternoon meeting with Democrats on Capitol Hill as he pushes for voting rights legislation. Bloomberg Government's Emily Wilkins has more on Senate Leader Chuck Schumer's plan to force debate.
They're basically going to kind of Trojan horses. They're going to put the voting rights bill into a completely different bill that's already passed the Senate once, and that's going to get it over this procedural hurdle and allow senators to actually begin debate on a voting rights bill.
But Emily Wilkins reports it still takes 60 Senate votes to pass the bill. Democrats could change the rules, but West Virginia's Joe Manchin is resisting. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Katie Greifeld. She's in for Tim Stanovic on this Thursday. You're listening to Bloomberg Business Week live in our Interactive Broker studio, also streaming on YouTube. Katie, have you been out shopping for homes at all?
You know, I've spent many a night on Zillow. And, you know, there's not a lot for sale. And the ones that are for sale, they cost so much. I can't say I'm shopping for homes, but it seems like everyone else is, because one of the most popular stories on the Bloomberg today, Westchester runs out of home listings in rush to NYC suburbs. At the current pace of deals, it would take just 1.3 months to sell all of the single-family homes available in that county, Carol.
Someone was telling me, one of our colleagues here, about a friend looking for a home in Westchester, and they're like, there's just nothing out there. I have a brother who's about to list a home, or is listing it, just put the listing out. I think they're doing their first showing on Friday, and there's something like 30 people already signing up to look at it. It's like just crazy.
Believe it.
Right?
You know what's crazy is that
Maybe
this is still happening, this rush to the suburbs. I mean, it's been, almost 2 years? I feel like we've been talking about this for at least 18 months, that people are just moving out of the city, and it's still happening. It's wild to see the housing market still in this frenzied state so long in.
I almost wonder, initially everybody kind of ran to the suburbs because they wanted more space, and they knew that this was going to go on for some time, and maybe rented, or maybe there were some people who started to buy, and maybe now at this point, people have got employers who said, you know what, you can work wherever, or you don't have to be in the city, so they're now saying, okay, now I'm going to really buy that house, or trying to.
I mean, in a lot of ways, this is the new normal for a lot of people. You and I are in the studio, but a lot of people are working remotely, so we'll see. One interesting stat that caught my eye in this article, that the prices slipped actually 1.8% in the county, just because it's all types of homes that are selling. Also on the lower end, it's not just these big mansions that are selling. It's all types of homes.
Yeah, and I think about those first-time home buyers who just are not even having an opportunity. Anyway, it's something we certainly look forward to reading about and talking about, and it is among the most read on the Bloomberg. You are listening to Bloomberg Business Week. Carol Masser, Katie Greifeld. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market is trading lower at this hour. We'll give you the details momentarily. Within the last few moments, we learned the Supreme Court has blocked the centerpiece of President Biden's push to get more people vaccinated. The High Court has rejected an OSHA rule. It would have required 80 million workers to either get shots or periodic test. Now, the court did allow, or is allowing, a separate rule to take effect. It will require shots for workers in nursing homes, hospitals, and other facilities that receive Medicare and Medicaid payments from the federal government. I'm looking at the S&P Pharmaceutical Biotech subgroup right now, weaker by about 1.6%. Generally speaking, the market is trading lower. A lot of weakness not only in pharma stocks, but in information technology, and that's dragging the NASDAQ composite down by more than 1.7%. The Dow a bit on the back foot here with a loss of about 0.1%, but the S&P 500 is down about 0.9%. Through the day, the market has been assessing this data that we had early today on wholesale inflation. Producer prices rising just 0.2%. That's about half of what the market was expecting. The reading, though, has really not changed the conversation on interest rates. Today, Fed Governor Lael Brainerd, during her confirmation hearing, was saying tackling inflation is the most important task. And the head of the Philly Fed Bank, Pat Harker, was saying he favors March liftoff and 3 or 4 rate hikes this year. But curiously, long-term interest rates are trading lower. A 10-year Treasury now at 170. We're down by more than 3 basis points. Even the 2-year is off by more than 2 basis points at 89 basis points. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. You are listening to Bloomberg Business Week. Carol Master along with Katie Greifeld on this Thursday. Well, Katie, the Bloomberg Business Week year-ahead issue, it's out. They are looking at the trends, the companies, the movements, the things that you really got to watch out for this year. And that includes a story on Hollywood heading back to theaters and really
Connection lost.
Moviegoers end up following. That new issue is out on newsstands, online at Bloomberg.com/Businessweek, and also on the Bloomberg terminal. Let's bring in Bloomberg Business Week editor Joel Weber. He's on the Access line in Brooklyn, along with Bloomberg News reporter Brian Eckhouse on the phone in L.A. Joel, have you been back to a movie theater?
I have, and it was like one of my favorite moments in the pandemic. It was like, wanted to make sure that I saw Dune on a big screen, and it was totally worth it. I love doing it, and if it weren't for Omicron, I would be there like every week, I think. So I'm bullish on movie theaters in general. I think it's a thing that people love doing, and they want to be doing it again. And I think Hollywood feels the same, right, Brian?
Yeah, they do. There's definitely a big push to get big films, established films, names, The Batman coming in March and others, to try to make an event, an experience again. Dune was available on HBO Max. That's where I saw it. It was beautiful, but didn't have the sweep that you would have seen on a big screen that Joel had.
Okay, I'm curious to hear.
You haven't been, have you?
I have not been. The last movie I saw in theaters, January 2020, Cats. Have not been back since.
Long time.
I heard that.
Fitting. I could have guessed that's what you saw.
I know. Unfortunately, I have a very defined brand. But in any case, Brian, talk to me about the theater exclusivity, because you have sort of seen this trend emerge where, okay, a movie will get released in theaters, it's exclusive to theaters for 45 days, I think is the stat I saw, and then it's available online on streaming services. I mean, is that the way of the future, or are theaters trying to change that?
Well, it's the way of right now. Before the pandemic, we would see films come out on streaming services maybe 3 months after it hits theaters. Before then, it was a lot longer of a time period. Last year, some of the studios, including Warner Brothers, they put films simultaneously in theaters and on services like HBO Max. Theaters didn't like that. It really crimped their receipts. So sort of a compromise and experiment going forward to doing that 45-day thing you're talking about, really have films in theaters, if it hits theaters, for, a month and a half, and then it'll hit HBO Max, it'll hit Peacock, Paramount Plus, and others.
So Brian, talk to us about what it's going to take for you to go into a theater. Is it going to be Tom Cruise? And is it going to be Tom Cruise Top Gun, or is it going to be Tom Cruise Mission Impossible?
That's a good question. Before Omicron, I was looking forward to seeing Licorice Pizza, which is in theaters right now, the latest Paul Thomas Anderson movie. I haven't seen it yet. Looking forward to seeing it. I think The Batman in March might be what gets me out next.
And what about Hollywood? Like the first movie that we're really going to see this strategy come to bear on is going to be Ambulance, right?
That's one of the first coming out. Peacock's film. It's a Universal film that'll hit theaters in April, and then 45 days later it'll be on Peacock. I think we're going to see a film that came out last week, 355 from Universal. Very similar. Will be on Peacock probably in late February.
You know, I do wonder, too, about the increased competition just for talent and content, right? The streaming services are still going to be competing for lots of stuff. You know, what does this do to the price of things, especially as we kind of increasingly move towards normal? Any indications? I mean, it sounds like box office receipts are still going to be a little bit down once we get back to a little bit more normal.
Yeah, I mean, we'll see receipts be below where they were before the pandemic, although it'll almost certainly be nearly double what it was last year. So theaters are going to see a bit of a return, not what it was, pre-COVID. In terms of the streaming sites, they're focusing really heavily, as you said, on driving new subscriptions, on growth. And for a lot of the studios, they're focused increasingly on these services, even more so in some cases than what they put in theaters.
And Brian, you mentioned simultaneous releases, putting big films out online and in theaters at the same time. Theaters, I get it. They didn't like that model. Did anyone like it, though? How did those films actually perform?
A lot of the films had dulled box office receipts. King Richard was on HBO Max, came out I think in November around Thanksgiving, simultaneous release. It was pretty well reviewed online. It didn't get a great box office. We've seen that in other cases as well. Matrix did okay last month, but again, it had that release at home. In the case of Dune, again, I saw that at home. I didn't see that in theaters. It may have dulled, the box office receipts or gross for these films.
I thought the Dune one was a particularly interesting case study, Brian, because it was like, one of the things that just jumped out to me as we're looking at this 2022 lineup where you've got, a Batman movie and Tom Cruise movies. Like these are like Avatar 2, which we haven't even mentioned. Like we've got known entities, and Hollywood always loves a sure thing. At the same time, it's like I kind of want to go to a theater and just see a big, awesome movie that isn't a thing I've seen before. Jurassic World being yet another thing that's coming out. So Carol, Katie, here's my question for you: are you more inclined to go see something that's a known entity, or do you want to see something that's totally new from Hollywood in a theater?
I don't know about
What's
you,
the thing that brings you back?
I don't know about you, Katie. I want to see my dinosaurs up on the big screen. Just totally. But I think a known entity, I'm willing to be like, okay, I know that's something I want to see on the big screen. What about you, Katie?
Yeah, I would go in for Cats 2, but in terms of what might get me into the theater again, I mean, I'm terrible at watching movies. I just fall asleep anyway, so I'm probably not the target audience that these theaters are worried about anyway.
What about you, Joel?
Well,
I'll go back. The moment that I can go on a date night and not, be worried about Omicron, like I will take that option, please. Brian?
Yeah, I mean, I think what's really good for Hollywood this year is because of the postponements from COVID, you had this really, really strong slate of big movies. This is really going to test whether people want to come out to the theaters or not, because you have such a robust lineup of well-known content.
Yeah, I'm missing those big cushy seats. You kick back, your feet go up. I'm just going to say. All right, guys, fingers crossed we can get back to those movie theaters more so in 2022. Joel Weber, editor of Bloomberg Business Week, and Brian Eckhouse, reporter of Bloomberg News. Catch the year-ahead issue of Bloomberg Business Week on newsstands, online at Bloomberg.com, and also on the Bloomberg Terminal. This is Bloomberg Radio.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by our colleagues Carol Massa and Tim Stenovic. Apparently hit the slopes, I understand.
Yeah.
Instead, we look at what's sliding right here, right now, and it's
That's a
tech stocks.
slacker. You would never leave us like that, Taylor, would you?
No.
Quiet.
No comment.
She cannot wait to get back out skiing.
I'm ready to come back. Can I come out of the timeout chair yet?
There's a lot of timeout chairs today. We're dealing a lot with COVID. Today, I keep watching what's going on in the bank world. KBW Bank Index still up about 0.5%. It's been on quite a run this year already, Caroline, but I'm looking forward to some of those big bank earnings tomorrow.
Yeah, earnings going to come thick and fast, but it speaks to that rotation, on again, off again. Today it's back on when it looks at perhaps value outperforming the technology stocks. We're down 1.65%, currently 1.66. 252 points anyway lower on the NASDAQ. So big tech taking a hit as once again we confront a March rate hike front and center. Lael Brainard seemingly once again reconfirming that viewpoint. The 0.9% lower for the S&P 500 off by 40 points. Volumes up some 13% there. The Dow had been your outperformer, had been in the green, but it slips into the red. We're off by 19 points. And the Russell 2000 just clinging to the gains. Maybe just some of those financial names helping push a little bit higher, Taylor.
Yeah, you do and see that, at least here on a sector level as well. There's a lot of green, some red here too. Take a look at some of the industrials and the utilities and the staples. That's really here what's in the green. That really highlights, Caroline, as you were alluding to, maybe the push-pull in the market. The industrials, that risk on tone, but the utilities, some of those bond proxies up there in the green as well. Romain, it is not lost on any of us that it is big tech, once again, down at the bottom. You're off 1.8% on the sector level.
Yeah, and I've been saying this for the last few days. I mean, keep an eye on some of the software names as some degree of a barometer of risk sentiment. Microsoft down once again, down 3.3%. Zscaler, one of those high and multiple software enterprise value kind of names, down about 7% here on the day. Now, if you're looking for a bright spot out there, you're actually going to find it in some of the chip equipment companies. Taiwan Semi up about 6.5% here on the day. Some relatively bullish commentary here that with all the disruptions going on in the chip space, they're actually benefiting from it. You're looking at Lam Research and a few other companies also higher here on the day. And TPG, you had an IPO come to market today. They're actually doing pretty well here. TPG shares higher by about 17% off of that IPO price.
Meanwhile, of course, we want to look at what other data we got throughout the day. And we are all so focused on inflation. We know that. Interesting reading coming. We had CPI yesterday, 7%. PPI actually slowing just a little bit on the overall out-and-out level. We saw it was up, for a year earlier, 9.7%. Still second largest in figures to 2010, but it did cool slightly. You strip out food and energy, though, and actually it didn't roll over as much. So are we therefore bracing for energy not to have peaked and therefore inflation not to have peaked at the moment? I wonder what the Fed would make of this chart.
Yeah, listen, I don't know, but we've certainly heard from a lot of members of the Federal Reserve this week, including Jay Powell in his confirmation hearing. Speaking of confirmation hearings, Lael Brainard up on Capitol Hill today, going for the vice chairman spot, and she had some comments to talk about inflation in particular, but also that balance between Fed policy and making sure you don't do too much to slow the economy down. Here's what she had to say.
Inflation is too high, and working people around the country are concerned about how far their paychecks will go. Our monetary policy is focused on getting inflation back down to 2% while sustaining a recovery that includes everyone. This is our most important task.
All right, that's Lael Brainard up on Capitol Hill this morning. You know, I don't know if you guys are hearing more conversations, but I am hearing more. Randall Krasner was up on TV with David Weston. Just this balance, it's going to be very tough for the Fed to thread the needle correctly and get policy right.
I think so, but are they talking balance? I mean, I don't hear balance in some of those comments. I mean, she says that, but when you listen to what Brainard said, when you look at the interviews that we had earlier with Michael McKee, I think it was Loretta Mester, and then some of the commentary we heard from Mary Daly, from Patrick Harker, even Raphael Bostic, there's no ambiguity right now, at least about the idea that March 26th, that March meeting, is a live meeting, that they are seriously considering lifting rates here. And I think the removal of that ambiguity is rattling a lot of markets. As we speak right now, you got both of the NASDAQ indices on the lows of the day, back down 2% here on the day. And you got a lot of folks out there that have to reassess here not only what the Fed is going to do, but how fast they're going to do it.
Have they not been reassessing since the start of the year?
And you got Bullard talking 4 hikes. What is he talking about?
How have they not been hearing this already, though? I'm kind of surprised. Leo Bernard was by no means the final sort of shoe to drop in terms of March being live. We've been hearing this again and again for the past few weeks. Why did we suddenly have that slight dip buying in the last couple of days? And why then today do we reavert and worry once again about a March rate hike when really that felt like that was driving market sell-off previously?
Yeah, that's a good point. I think Mike McKee had a good point saying that January will really help that January meeting lay out the tone for the year, set the agenda when we're thinking about pulling forward QT, the roll-off of that balance sheet, which is a much shorter window than we had in the 2015-2017 cycle. I will just bring you one note as we are in the day-to-day and you see a NASDAQ that sells off 2%. It is a UBS strategist saying that rising rates, they don't really change the narrative so much. If you're looking at the first 3 months after a rate hike, the S&P on average has still gained about 5%. Yeah. That is the push-pull in these markets.
And the tech tends to be the outperformance. I want to mention Charlie Evans because there's some headlines crossing. Of course, the president of the Chicago Fed, and he says the time between the rate liftoff and balance sheet roll-off seems shorter. And maybe this is what's worrying markets a little bit. We know that the Fed is going to start raising interest rates, Caroline, but it's that, what's the time between when they do that and then use another tool in their tool chest to start take some of the liquidity out of the markets?
And that, of course, is what roils stocks, what overall has seen the inflation of assets worldwide. What's interesting, Romain, is how much now we see the outperformance of emerging markets versus developed markets. How now we start to see, though the dollar actually rolling over, the dollar seems to have priced in that we're going to get rate hikes right now.
I think you pointed this out, I believe, last week, and I think a lot of people need to refocus on what we're seeing in the FX market, and that gives you a little bit better of a read here, even if I dare say, Taylor, than the bond market right now, of where a lot of risk sentiment is right now. And you talk about the outperformance that we've seen over emerging markets. They are down a little bit on the day today, but over the last few weeks, you've seen an outperformance here that could actually be maybe the narrative, at least for the next few weeks.
I'm not close enough to you to kick you under the table, Romain, so we let you get away with that comment. Carol, just quickly here, Cameron Krice out with a really good piece. Typically, you would see some of the dollar strength in a hiking cycle, except for the fact that if you hike and all U.S. assets underperform, that is the dollar weakness we may be seeing.
All right, we'll continue this. That's going to do it for now. We're going to be back together live on radio, TV, and YouTube for Beyond the Bell, our cross-platform coverage. We're going to count you down to the close on this Thursday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, you are listening to Bloomberg Business Week. Carol Masser, Katie Greifeld in for Tim Stenovic, who, yes, is up on the slopes today. Hope he's skiing carefully in the great outdoors, staying warm, because it's pretty cold here, and I'm guessing where he is, it's even colder, Katie. Just putting that out there.
Yeah, Canada, it seems pretty chilly. It's pretty cold here this weekend, too, though, so we're all feeling it.
Talk a little bit more snow. A little chilly when it comes to the equity trade. We just talked about that with our TV team. We're sorry you were not there. I know because of COVID, we're all kind of moving around, and it's a little tricky to make it all happen right now.
Looked like you guys had fun, though, so watched from afar.
And you're fun if you're short in this market, because right now we've got, the S&P Dow, NASDAQ pretty much bouncing around its lows today, but we're seeing tech really the underperformer here.
Yeah, and this is surprising because, if you look at across the bond market, which it really feels like that's where tech has been taking its cues from, that's not, the relationship that we've seen. You see yields lower. Typically, that's good news for tech. Not today. To see the NASDAQ 100 fall 2%, it's a bit of a head scratcher.
Right, and the yields have moved back down. I'm curious, and I think the Business Week coverage story, the big concern in terms of global economy and global markets by our Stephanie Flanders is not about COVID. It's about a policy misstep and maybe getting inflation wrong. But, there's been a lot of conversations I certainly am hearing more and more from people concerned. Randall Krasner talking with David Weston, a former Fed governor, saying it's really tough for essentially the Fed to get it right here and maybe not overdo it when it comes to monetary policy, and that could ultimately lead to an economic slowdown.
Absolutely. It is such a precarious line for the central bank, both the Fed and globally, to thread the needle between inflation and growth. So it'll be interesting to see this play out.
Exactly. All right, we're going to continue. Katie Greifeld with me on this Thursday. You're listening to Bloomberg Business Week. Off to D.C. we go, and Nancy Lyons with World and National News. Hi, Nancy.
Thanks, Carol. The Supreme Court is blocking the Biden administration from requiring workers at large companies from getting shots or coronavirus tests. But the High Court is allowing a separate rule requiring shots for most healthcare workers. Well, President Biden is beefing up the deployment of rapid COVID tests, now planning to ship another 500 million to Americans. That's double what his administration is already in the process of acquiring. The president says this is still a pandemic of the unvaccinated.
You are 17 times more likely to get hospitalized. As a result, they're crowding our hospitals.
President Biden says he's sending military doctors and nurses to 6 hospitals under the toughest strain, and he says the government will soon announce a plan to make high-quality masks available for free. The top Republican in the House is defending his refusal to testify before the committee investigating last year's attack on the Capitol. Minority Leader Kevin McCarthy says he does not believe sharing his conversation with President Trump from that day would add much to the investigation.
There is nothing that I can provide the January 6th committee for legislation of them moving forward. There is nothing in that realm.
The committee wanted McCarthy to cooperate voluntarily and must now decide whether to subpoena the Republican leader. Well, leaders of the far-right group, the Oath Keepers, were charged today with conspiring to prevent the certification of Joe Biden as president by joining in the attack on the Capitol. The indictment charges Stuart Rhodes, described as the founder of the group, and 10 others with seditious conspiracy. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar, along with Katie Greifeld on this Thursday. I'm combining your name. Sorry, giving you a new.
Yeah, it's fine.
Crypto. I know you and Tim often talk about crypto a lot on Quick Take. Anything that you were covering today earlier?
Oh, man. Well, I've got my eye on the fact that you're actually seeing a lot of crypto firms invest in, traditional finance. It's been the other way around for about a decade now, or really just for the past few years. But now we're seeing, you have some of the biggest cryptocurrency exchanges, FTX US, Bitstamp USA. They're actually looking at offering stock trading. So
Wait,
you'll
what?
be able
What?
I know, right?
What
It's
does that
so
mean?
Weird. It's I guess you'll be able to, trade just normal old vanilla equities alongside your Bitcoin, your Ethereum, your Doge. And this is a step that we've seen traditional firms take.
Yeah.
Robinhood, for example, you've been able to trade crypto there for a while, but I guess these cryptocurrency exchanges, they're trying to diversify their revenue and they're becoming more normal.
Well,
really.
I meant, we just talked with Jill Weber at Bloomberg Business Week, and the issue's all about the year ahead, and they have a whole big section on fintech. And they talk about kind of what might happen this year and talk about how a lot of fintech apps, they come out and it's kind of a one functionality or one main functionality, and then they start adding things on. And I wonder if that's kind of what's happening as a way to maybe increase the revenue streams of some of these crypto exchanges. I don't know.
It feels like it because a lot of these exchanges, they're just a couple of years old. So they
Yeah.
have a proof of concept. They have like the steady revenue stream. How do you grow beyond it? Especially if, we've seen the price of Bitcoin really tumble in the last couple of months. If there's more of that ahead, how do you continue to make money? And interestingly enough, they're going right into traditional finance.
It is pretty interesting. And as you said, it's kind of backwards, right? It's the traditional guys adding on all of these alternatives. But if you think about it, they've got this audience, right, of probably millions of users. So how do you kind of take advantage of it? All right, you're listening to Bloomberg Business Week on this Thursday. I'm Carol Massar, along with Katie Greifeld, and you are listening to Bloomberg Radio. Coming up soon, we've got the chart of the day.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market is on the back foot. We're about 42 minutes away from the closing bell. NASDAQ Composite near session lows. Let's get you the very latest on the price action. Bill Maloney is at the Bloomberg Macro Squawk Desk. Hi, Bill.
And good afternoon, Doug. U.S. stocks heavy again today with the NASDAQ again under pressure. Dow's currently down 92 points. S&P's dropped 51, is trying to hang on to the 50-day, while the NASDAQ is down 307 points. The U.S. 10-year yield falls to 1.7%. Gold is down 5, and Bitcoin drops by 3.2%. Among the main 11 S&P sectors, leaders were industrials and utilities. Tech and consumer discretionary were in the red. And leaders to the upside on the Dow, Boeing and Caterpillar, while Microsoft, Salesforce, and Apple led to the downside. After earnings, Delta rose as much as 4.8%. And regarding IPOs, TPG opened at 33. In other news, Fed's Evans says we may have 4 rate hikes if inflation data does not improve. And The Verge reported that Tesla removed the 2022 production date from its Cybertruck site. Wrapping things up, Ford Motor topped $100 billion in market value. Live from the First Alert Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thank you. To get live breaking news on the Bloomberg terminal, the function is SQUA, then the green go key will get you there. Going to be a very important day tomorrow. A couple of key data points: retail sales, business inventories, industrial production, and earnings from a couple of the big banks. We'll talk more about that coming up on Bloomberg Business Week. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, got it, Doug. Thank you so much. So this definitely showed up on our radar today. It's about the many scandals over at Meta, formerly known, of course, as Facebook. And Katie, how some of this may be a bit demoralizing for employees. Wouldn't you think it's the case, especially as they're trying to recruit folks in? It's like, what?
I would think that's pretty difficult on their recruiting team. It did catch my eye that it didn't seem like a lot of the disfaction had to do with COVID, which I feel like when we hear about employee morale, it has to do more with COVID than anything else, but not with Meta.
Yeah, that's a really good point. Hey, let's get all the details, though. Bloomberg News tech reporter Kurt Wagner, he put it out there on the Bloomberg. He is on the phone from our San Francisco bureau. So, Kurt, what's exactly going on here? And what's everything that's got so many of those Meta employees down?
Yeah, well, I mean, this has been a couple of years in the making, as I'm sure you both know.
Yeah.
I mean, you've seen stories, right? First of all, I think the most obvious is there's just a lot more leaks coming from Meta, formerly Facebook these days. You know, that's usually a sign employees aren't super happy. I think a year and a half ago or so, we saw an actual walkout from employees who were not happy with how the company handled President Trump's post. And then this week, you know, what kind of prompted this, I wrote this in our newsletter this morning, what prompted this was Glassdoor does this ranking of the best places to work. And Facebook is usually in the top 10. In fact, 3 times it's been the #1 place in the world to work. And this year it was 47th. And it was just kind of a reminder that this company that has historically been, you know, the dream job for a lot of people is not really the case anymore. And I think, you know, it's just proof that a lot of the drama and scandals they dealt with over the last couple of years is actually having an impact.
And Kurt, that's exactly what leaped out to me. That, I mean, Meta, formerly known as Facebook, it was the #1 company 3 times to slip to 47. I mean, what happened? Is it just that, you know, Facebook, now Meta, is just a bigger, more publicly out there company? But, I mean, it's just an incredible drop. How do you explain it?
Well, I think, imagine, you know, what it's like to work there, and kind of every 2 months or so, it feels like you are dealing with some kind of scandal that, you know, questions like, am I doing good in the world, right? Like, that is the question that a lot of employees have to ask themselves regularly. And I think that came to a head this year with some of the Facebook papers. You know, we had the Facebook whistleblower who came out and released all kinds of internal documents. And, you know, the CEO is often testifying before Congress. And it's just like a lot of heavy stuff to think about on a day-to-day basis when you're trying to do your job. And not a lot of jobs have that. And, you know, to Facebook's credit, it's because it's very influential, and that's why a lot of people like to work there. They can have huge impact.
Yeah.
But at the same time, with that impact comes a lot of questions about what that impact is, and I think people struggle with that.
Well, and I also think about, you know, losing employees costs a company something, right? You lose an employee who might have been pretty productive that led to top and bottom lines gains at the company. It costs a company to recruit, train, and all that good stuff. There are also, though, some workers, like I think about engineers. We've talked about the tightness in the market. Everybody needs, programmers, engineers. I do think about how that might ultimately impact if they can't get engineers. Do they care as much, engineers, about what's going on in terms of morale? And if so, how that might impact Meta's bottom line or the ability to produce new products?
Yeah, I mean, certainly if you can't hire engineers, it's going to be hard to grow, right? I think that's pretty obvious. And I think stereotypically, you often think like, well, the engineering department, probably more than any other team at a tech company, is a little bit more heads down, right? Like they're just building, they're focused on the code, and they're maybe less impacted by some of the cultural things that happen. But at the same time, I mean, that's a stereotype, and it's not going to be relevant to every person who's there. And if you have a chance to go build something cool at a company that also aligns with your vision, of course you're going to go do that. And I think that's part of the reason we're seeing Facebook lean so heavily into this idea of a metaverse, right? It's something exciting, it's something futuristic, and if you're an engineer and you want to be building, products that are on the cutting edge, well, Facebook made a pretty public stand. Here's what we're building. Come join us. And I have to imagine recruiting was a huge part of that.
And so, Kurt, employees, a lot of discontent there, a lot of existential questions there. But what about advertisers? Are they asking the same questions? And have we seen any pullback in spending?
We have not. And that's part of the reason why I thought this kind of angle or this anecdote about the Glassdoor ranking was notable was, for years, we have not really seen a whole lot of anything change with Facebook because of all the stuff going on, right? You keep thinking, well, certainly advertisers are going to pull back, right? Or business is going to slow down as users leave the service. But that hasn't really happened, right? Despite all the bad things that have gone on around Facebook. And so the fact that, employees might be the one area where it's actually having an impact, I think was pretty notable. And I should point out, I mean, Facebook or Meta is huge. It has 68,000 employees. So it's not as if nobody wants to work there, right? It's just that at a certain point, it becomes harder and harder to recruit.
Hey, Kurt, just real quickly, 25 seconds here. Does the internal management, the senior management, do they care? Are they looking to make it better? Just quickly.
Yeah, absolutely. I mean, a bunch of people actually left last year, a bunch of high-ranking folks, but this has been the fact that you can't hire engineers has been a big issue for Mark Zuckerberg over the last couple of years. So this matters to them immensely, I'm sure.
All right, we're going to leave it there. Hey, Kurt, thank you so much. Really appreciate it. Bloomberg News tech reporter Kurt Wagner on the phone from our San Francisco bureau. Shares of Meta down about 1.6% in today's session, but we've seen a lot of big tech under pressure. Stocks down about 2.5% so far in this new year. You're listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
I think we get Cree to talk about pets rather than her chart of the day. Do you think that would be a problem?
I hope so. I mean, banks, sure, but pets, that's a conversation I want to have.
You love your cats. I love my dogs. I have a feeling she's going to stick to her chart of the day and banks. All right, we'll get to that in just a moment. Let's get back to Doug Krisner. Doug, if you could talk cats, dogs, or bank stocks, what would you do?
I'd talk the market right now. It's a very, very curious development that we're seeing right here. Within about the last half hour or so, the equity market is making new lows, and at the same time, we're seeing a drop in market interest rates. This is the way that I'm making sense of it right now, Carol. This morning's reading on producer prices was benign. We know that. PPI up just 0.2% last month. That's half of what the market was expecting, right? This tame reading, though, seems to have faded entirely into the background, and the market seems to be fretting kind of over the idea maybe the Fed is behind the curve. And I say that because Charlie Evans, the head of the Chicago Fed Bank, was saying a short while ago, monetary policy is not positioned to deal with surging inflation. So if the Fed has to be aggressive, and Evans was saying maybe 4 rate hikes this year, that seems to be kind of in the zeitgeist, it's being discussed. What if the Fed has to become a little bit more aggressive in removing accommodation? And now we've got the risk of a policy error. Pat Harker today favoring a March liftoff, and he is saying maybe 3 or 4 rate hikes this year. And Lael Brainerd, during her confirmation hearing, was saying tackling inflation is the most important task. That said, a 10-year Treasury at 169. We're down 4.5 basis points. A 2-year at 89 basis points, off about 3 basis points. The Dow down 0.2%. S&P 500 weaker by 1%. NASDAQ comp down 2%. I'm Doug Krisner. That's your Bloomberg Business Flash.
And then, Doug, you have to reckon that with people thinking that the Fed may do too much.
Well, that's it, right?
It's a crazy
That's
world.
what the bond market seems to be saying. There's a risk of a mistake and much weaker growth on the other side of it.
All right, Doug Krisner there. Let's get to Kriti Gupta, Bloomberg Markets correspondent. She's got her chart of the day. You're looking at bank stocks, which is so timely. Consider the big banks start reporting tomorrow, Kriti.
Yeah, it was like, Carol, I guess I do have to stick with bank stocks, although I would love to talk about my puppy Harvey.
To be
but,
continued.
To be continued, yeah. So my chart really just shows the KBW Bank Index against the S&P 500 Value Index. It shows that a lot of these banks, in particular, not financials broadly, but these banks, Goldman Sachs, JP Morgan, these stocks have actually been outperforming for a good chunk of the post-pandemic era, but also really accelerated since the start of the year. And they're actually going into earnings season from a very strong position here, not only because the market is pricing in higher yields, higher rates, the idea that banks can actually get more bang for their buck when they start lending, but also expecting more loan growth and even more volatility, which would help some of those trading desks. So all in all, things are looking pretty good for those banks.
And I mean, Kriti, how important are fundamentals here? Because we had Jeffrey's report yesterday and slammed lower by 9%. Up today, though, it feels like, I don't know, these earnings reports matter for maybe intraday, but then it's right back to following the yield curve.
Yeah, well, if you actually were to transplant the 10-year yield onto my chart of the day, it would look exactly the same, which really, to your point, does tell you that you are seeing this bet on financials largely driven, once again, by those rate hike bets, by those inflationary bets. The earnings story, though, I'm very curious. They're actually walking in with some pretty high expectations, so they actually have to live up to them to see that rally continue into tomorrow.
Yeah, that's a good point. KBW Bank Index up almost 12%, so you do wonder how much of the expectations about earnings may be already factored in, but we will find out as they report. Kriti, thank you so much. We'll talk dogs and other things later on. Kriti Gupta, Bloomberg Markets correspondent at Bloomberg News. We do want to get to a headline that crossed just about an hour or so ago. The Supreme Court blocking President Biden's COVID shot or test rule for workers. Here on what it means is Bloomberg News legal analyst June Grosso, host of Bloomberg Law on Bloomberg Radio. She joins us right now on the Access line in New York City. Seems like a pretty significant ruling here, June.
Yeah, it is, Carol, but I think it was expected. I mean, even the Biden administration knew that in getting OSHA to make this rule, that it was going on the outer limits of OSHA authority. OSHA was acting in a way it never had under a special circumstances, saying that it was reacting to the COVID pandemic. And what the court said is they really read the statute very, very narrowly, as this court is wont to do with all the textualists. It said the COVID threat isn't connected to the workplace. I think one line says it all. They said, although COVID is a risk that occurs in many workplaces, it is not an occupational hazard in most. And so they said that OSHA basically didn't have the authority to set up this rule.
And so, June, what does this mean for the Biden administration? What's next? Because I would imagine in, the administration's campaign to boost vaccination rates in the country, I mean, CDC says currently only 63% of the country is fully vaccinated. This would be a pretty big setback. So what's expected next?
It's hard to say what the Biden administration is going to do next. This has definitely shut off the ability of OSHA to make any regulations. But I think that what the Biden administration is thinking and saying to itself is that, well, we accomplished a lot already. Just putting this rule into effect, it led to a lot of private businesses putting their own rule into effect. It sort of set a standard that that businesses could emulate. And so I think that it's sort of accomplished something, even though the final rule didn't manage to be accepted by the Supreme Court. And the three liberals on the court, in their dissent, were a little bit snarky, I think, toward the majority. They said that the court was lacking any knowledge of how to safeguard workplaces and insulated from responsibility for any damage it causes. So that was the liberals saying, this is a pandemic, and agencies should have the authority to do it. I mean, Joe Biden could try an executive order, but I doubt that he would do that, because an executive order will just end up in the same place that this rule did. And people criticize executive orders as saying that it's the president going beyond his authority. And here we have the Supreme Court saying OSHA doesn't have the authority, and the president probably doesn't have the authority either.
June, just got about 40, 50 seconds left here. Does it say anything about kind of maybe how the Supreme Court might be in future rulings about other issues, or is this really kind of an isolated case?
I don't think it's isolated. I think it's a question of agencies. And, this is a Supreme Court that really wants to control agencies, or the so-called administrative state. So they want to keep agencies like OSHA right to the rules and right to the authority that they have. They don't want them to be able to go outside that. And even in the second case, which involved Medicaid and Medicare and hospital facilities, and those Medicaid and Medicare places have all kinds of rules they have to follow. Still, there was a dissent from 4 of the conservatives who wouldn't even let that go forward. So you're going to see a lot more about this and about the so-called administrative state in the future.
Well, decision, a victory for 26 business groups and 27 Republican-led states that sued to challenge this OSHA policy. All right, June Grosso, thank you so much. Bloomberg News legal analyst June Grosso. She is host of Bloomberg Law. Catch that on Bloomberg Radio, joining us on the Access Line in New York City. All right, we now do want to head back to the nation's capital, Washington, D.C., of course, where the Supreme Court is. And, of course, Nancy checking on all of the world and national news headlines. Take it away, Nance.
Thanks, Carol. Well, as we were hearing from June Grosso, the Biden administration did suffer a defeat today at the Supreme Court. The justices ruled the government cannot require workers at large companies to be vaccinated or tested. But the justices did allow the administration to require vaccinations for most health workers. Well, the administration is ramping up its efforts to tamp down the virus. President Biden says they will double to 1 billion the rapid at-home COVID-19 tests to be distributed free to Americans. And he says high-quality masks will soon be available to those who need them.
I know that for some Americans, the mask is not always affordable or convenient to get. So, next week we'll announce how we are making high-quality masks available to the American people for free.
Biden says he knows everyone is tired of masks, but he says they remain an important tool to stop the spread of the coronavirus. A dramatic change could be coming to the next presidential election cycle. We get the details from Bloomberg's Nathan Hager in Washington.
It's been a mainstay of campaigns going back to the Reagan years. 3 televised presidential debates and one for their running mates, sponsored by the Commission on Presidential Debates. But the Republican National Committee now plans to change its rules so that its candidates will have to pledge not to take part in any debates sponsored by the Commission. In a letter today to the Commission's co-chairs, RNC Chairwoman Ronna McDaniel said her party has lost faith that its nominees will be treated fairly. One of those Commission co-chairs, Kenneth Wallach, says he hasn't seen the letter yet and can't comment. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our Washington, D.C. Bureau with World and National News. I'm just going to say, Katie, now it's serious.
It is serious. Inflation has officially gone too far. The Federal Reserve has to hike interest rates because desk salads hit by the worst inflation in the U.S. You have the price of romaine lettuce soaring 61%. Carol, it's at an all-time high. It's incredible.
Can I just say, this is what I love about the Bloomberg. Like, I'm reading about the Goldman stories, and I'm reading about some really serious stories about, what's to come in terms of COVID, and of course about inflation, all the Fed speakers this week. And then you get a story like this, and I kind of love it because it fits into our world.
Absolutely. I mean, all those guys at Goldman, they're eating desk salads. We're eating desk salads. It's getting more expensive.
Don't you think they eat more kale? Or maybe they don't eat more kale.
I don't know. I mean, maybe you're going to diversify into kale now because a pound of romaine lettuce, I didn't know that was a unit of measurement, but
apparently
costs now $3.27. That is the highest in data. Going back to 2006, you also have ground beef also up 17%. So lettuce, I don't know, supply chains, inflation.
Up 61% from last year. Ground beef is up 17%.
It's incredible. And I love that, again, this is a really full story. We have a lot of information in here. Bloomberg News talked to Victor Smith, Chief Executive Officer of JV Smith Companies. Relief from pricey lettuce, it's uncertain. You have record fertilizer prices, increasing cost of fuel, potential for drought. It's all adding up to more expensive lettuce, and that's cutting into, or it's boosting your lunch bill.
Well, it's understanding those input prices, right? And I think, listen, we're having some fun here, but we talk about inflation. It's not funny because we know it's impacting everybody's pocketbooks. It's certainly impacting any kind of wage increases you get.
Yeah.
And this is something that the longer it goes on, the more problematic, Katie, it becomes for individuals.
Absolutely. And I mean, you heard that from Lael Brainerd that, for average Americans, this inflation, it's really, it's a weight that they have to deal with. And I mean, this lettuce case, it's a great example of that. It's just more expensive to live right now.
All right. You're listening to Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We're less than 13 minutes away from the closing bell. Not a lot of appetite for risk at this point in time. The equity market is drifting lower. In fact, the NASDAQ comp down about 2.3%, near session lows. And curiously, interest rates across the entire yield curve are lower. The day began with a very benign reading on wholesale inflation. PPI was up just 0.2% last month. That was half of what the market was forecasting, but it's ignoring that data point at this point. Markets seem to be addressing the idea that maybe the Fed is behind the curve. Charlie Evans, a short while ago, he is the head of the Chicago Fed Bank. He was saying monetary policy isn't positioned to deal with surging inflation. Think about this. If the Fed has to become a little bit more aggressive, is there a risk of a policy error? Maybe they overshoot and create weaker growth on the other side. That seems to be reflected not just in equities, but in crude oil as well. WTI down 1.3% right now, trading 81.55. The Dow weaker by 0.5%. Information technology being clocked. We've got to the S&P 500 down 1.4%. NASDAQ comp weaker by more than 2.3% right now. Interesting, tomorrow, a couple of key data points: retail sales, business inventories, industrial production, also from the University of Michigan, the latest reading on consumer sentiment. And keep your ear open. We'll be hearing from the president of the New York Fed, John Williams. I'm Doug Prisner. That's your Bloomberg Business Flash.
The following is an editorial from Bloomberg Opinion.
U.S. consumer prices rose 7% in 2021, the largest 12-month gain in nearly 40 years. The good news is that the Federal Reserve can no longer be accused of playing down the risks of inflation. Its policy stance has moved briskly from patience to concern, with a hint of alarm, in recent months. To its credit, the central bank has pulled off this abrupt shift in messaging without roiling financial markets. Investors have calmly penciled in 4 interest rate hikes this year. That sounds about right, but with the pandemic far from contained, the Fed needs to keep an open mind. Amid so much uncertainty, the central bank shouldn't box itself in to a fixed policy. Instead, it should stay ready to tighten or loosen policy as conditions evolve. Moving forward, flexibility will be key. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 9.5 minutes left in today's trading session, and we are seeing those major equity averages. Doug just talking about them a few moments ago. They are at their lows of the session, so down about 2.5% on the NASDAQ, really feeling the underperformance among those 3 major equity averages. But the S&P also down about 1.5%. This is ahead, of course, of tomorrow's big banks starting to report earnings. We'll hear from J.P. Morgan, Citi, so that will certainly help impact the tone of the trade. Let's get to the drive to the close. Kate Fettis is with us. She's President and Chief Investment Officer at Grace Capital. They're a Boston-based registered investment advisor. She joins us on the phone from Boston. Kate, nice to have you here with Katie Greifeld and myself. So the market trade, I don't know, it's a volatile one, safe to say. We've seen some losses, we've seen some rallies. What do you think fundamentally might be the tone of the markets as we just get ready to kick off that earnings season?
I think fundamentally, thank you for having me, Carol and Katie. Fundamentally, the market is looking to take a pause. It's looking to take a pause because we've had 3 very strong years. Last year, the market was up 29%. And what's fascinating about it is if you look at how it happened, the market was up 29%. It did better than the Russell 1000 growth and better than the Russell 1000 value. So that tells you that it was a very narrow market. The top 10 companies playing an outsized performance in the market. At the same time, even though the market is a little worried, they're like, oh, we had a big year, we got to calm down. you think about it, strictly looking at the facts, the S&P 500 PE multiple declined from 41 times a year ago to 28 times currently. So the earnings in the S&P 500 actually grew 45% last year. So things are not quite as dire as, if you look at what's going on today, it would appear.
So, Kate, to your point, we've had 3 big years for the stock market, looking to take a pause now. We're also cruising into the Federal Reserve's liftoff from zero, potentially the first interest rate hikes since 2018. How do you position in that environment? What are you expecting? How is that going to play out?
I think it's hard to guess what the Fed is going to do in a general sense. So I am not someone who likes to make a lot of macro bets. Having said this, clearly, I think the Fed directionally has been very clear with what they want to do. In a general sense, the logic is, well, the Fed's going to raise rates, therefore you should, buy the banks and sell the tech stocks. Fed's going to raise rates, therefore the market's going to go down. Not necessarily. In a general sense, the Fed has proven itself to be quite dovish. I think if you really look at the way it behaves, it's clear that it's not so much about its mandate of full employment and 2% inflation as much as keeping the markets buoyant. So anytime they do anything and the market looks like it's going to react negatively, they back down. At the same time, it's not clear that raising rates will be bad for the markets. Janet Yellen raised rates from actually 0 to about 1.5% beginning in 2015. And the Dow Jones went up 70%, did extremely well. Only person with a better record was Greenspan. Because what happens when you raise rates in the U.S., it's a global market, you're going to attract inflows from Europe and Japan.
Kate, I want to go back to something you said at the top to Katie and me. And you said performance, and I'm looking at some of the notes too you shared with our team and our producer. Performance, you said, so concentrated that the S&P 500 performance bested both the Russell 1000 growth and 1000 value indices. You're talking about last year in particular. I just want to confirm that. And then are you saying that shows that there's a lot more room for gains by other equity plays, maybe not those big cap names, to continue the momentum?
There is a lot more room to continue the momentum. At the same time, because remember, at this point, more than half of the market is being invested passively. People just putting their money blindly into the index funds. So that creates some vulnerability because you think, oh, I'm going to be diversified. I'm just going to buy the S&P 500, not going to use the stock picker. And you don't understand really how vulnerable you are. That 35% of your performance is being controlled by a handful of stocks. So if that handful of stocks stumble, a passive index investor in the S&P will stumble along with it. An active manager, like what we do, where you're actually picking stocks, you could actually have a very good year despite the market in an aggregate sense doing poorly.
And so, Kate, as an active manager, where do you see the most opportunity right now, on the single stock level, but also on a sector level? What looks most attractive?
I'm going to answer that in sort of a long-term and near-term. And, I'm going to contradict myself a little bit from what I said not that long ago, but hey, that's life. On a long-term basis, technology is clearly the place to be. Mm-hmm. If you look at the market, it's very dominated by the big tech players. And actually, we ran this for our annual report. 34% of the S&P 500 has its headquarters in California, another 11% in the Washington state. So technology is an outsized part of the economy, global economy, and that will continue. In the near term, however, I think energy is actually interesting. We are also ESG investors, so in a general sense, we shy away from most energy, not all energy. And the overall market is very ESG centric right now. And as a result, you're having an underinvestment in traditional energy. So when you have an underinvestment with the same level of demand you've always had, in the end, globally, we have a growing population. India, Africa.
Right.
We got growing. So energy, I think, is very interesting. We've got a couple of names that we really like.
Just quickly, just got about 20 seconds, Kate.
Oh, okay. I'll go Cheniere. I like Cheniere Energy. It yields 5.5%.
Mm-hmm.
What we like about it is take or pay contracts. They sell gas. You got to go.
Yeah, we got to go. That means we're just going to have to come and have you back because we do like talking names. Kate, do have a good rest of the week and a good weekend. Kate Faddis, she's President and Chief Investment Officer of Grace Capital on the phone from Boston. All right, time to join our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, here to help take us beyond the bell. Our global simulcast partners, we're joined right now by Carol Masser. Tim Stenovic has the day off, bringing together our Bloomberg television, radio, and YouTube audiences. And Carol, let's get right to it. We're looking at a NASDAQ 100 and NASDAQ composite down about 2.5%. I want to point out the S&P is down about 1.5%. These are the lows of the day, but this is not necessarily a broad-based sellout. About half the stocks in the S&P are still in the green, but a lot of those tech names are really dragging us down.
That's a really good point, some good perspective. And I will also point out one of the groups that's really winning in today's section is the airlines sector. It's up about 2.5%. The S&P Super Composite Airlines Index is up, guys, thanks to Delta earnings. So we are seeing some of those winners in today's session.
Meanwhile, the losers, as we see, the NASDAQ really underperforming. But in terms of volumes, actually the action is really happening in the S&P 500 at the moment, up 16% versus your usual daily average. So people are putting money to work when it comes to those 293 stocks that are on the downside.
I think it was really interesting that we were speaking to Kevin Nicholson, of course, earlier, saying that the role of bonds in a portfolio is some of that shock that we feel on days like today's. Now, traditionally, in the past 6 months or so, he says that hasn't been working. But today, Romaine, you do see that. It is down 5 basis points on yields, at least here on the belly of the curve.
Yeah, and I just want to point out, too, I mean, the dollar, which we've been talking about all day, that dollar weakness, it was down about 0.2%. It's actually been flirting, going back into the green right now. So it's interesting to see people buying the dollar, buying bonds, selling off some of those stocks here. That's the setup, at least on a daily basis. What it means long term, who knows? Dow Jones Industrial Average, though, looks like it's going to finish the day down by about 0.5%, or about 170 points or so as we get the closing bell and wait for these numbers to settle just a little bit. The S&P 500 is going to end the day down by about 1.4%, or 67 points. The Russell 2000 down about 0.8%. But really, all the focus right now are on the NASDAQ indices, the composite and the NASDAQ 100, each down about 2.5% right now. We should point out, too, Carol, when you go back to last Friday, we were talking about this drawdown that we saw on the NASDAQ, basically about 7% from that all-time high. We clawed back some of those losses, but as of today, we're now down about 8% from those highs. So one of the most meaningful drawdowns we've seen on the NASDAQ indices going back several months.
Yeah, absolutely. We talk about dip buyers, but you didn't necessarily see that in today's session. You do wonder whether or not we'll see that over the coming days. I do also want to mention the VIX today, up about 2 points, 2.5 points, so hitting that 20 handle today. So volatility, we continue to see that in the trade.
Carol, let's take a look at where we are in terms of a sector level. You mentioned airlines earlier. I was talking about the cruise lines. That's one of the bright spots, as you can see here. The transportation index is up 0.4%, the third best performer. Other than that, everything feels very defensive. Utilities, food and beverage, food and staples, capital goods. That is that bond story, that defensive story. Otherwise, there's a lot of red, even in the winner section as well. We take you down to the bottom of the screen there with some of the losers, and that is where all of the technology really comes back into play. It's media, technology and hardware, semiconductor equipment, software services, auto components now. Those sectors are off anywhere from 2 to 5%.
All right, and Taylor, you set me up really well. I'm going to bring up aboard a couple of gainers, a couple of decliners in today's session. Taylor talking about big technology. Microsoft among them down about 4.25%. It's now down about 8% on the year. The software space, Romaine talking about that a little bit earlier. Now, ServiceNow, top decliner in the S&P 500, down 9% for the Thursday trade. Barclays lowering their price target to 680 from 791. That stock, you can see closing at 521 and change, so well below that, keeping the overweight rating. So what did gain? we had actually one company going public, TPG, big private equity firm. We talked about this early, up more than 15%. What, Romain?
I'm sorry. I always hate to interrupt you, but I do it anyway. But
No,
Carol,
please.
but to go
I
back
expect
to the
it.
point on the software, I mean, in all seriousness here, we talk about the weakness in those software stocks and the idea that it is really those high multiple tech names that have been moving lower. There was an interesting note out a little bit earlier, and I'm kind of forgetting the bank that put it out, but they talked about the idea that there were a lot of quote unquote value tech names, and there was kind of some of those old school tech kind of your Hewlett Packards of the world, your Dells, even IBMs, and those names mostly finish higher here. But when you get those software names, Bill, Sprout, Sentinel, Confluent, ServiceNow, Zscaler, Trade Desk, all these stocks down 7, 8, 9% here on the day.
You tell me, Romain, you're not comfortable with the a current PE of 441 on ServiceNow?
I'll pass on it.
I figured as much. That stock's down almost 20% so far this year. I mentioned TPG in its first day of trading, up 15%. And I do want to mention Taiwan Semiconductor. We talk about technology. It's important to do so. We watch those semi names. That name was up 5.25%. This is talked about a big spend, a CapEx spend in 2022. We're talking at least $40 billion, maybe as much as 44, and that was more than what the street was expecting, guys.
Yeah, you move across from what's happening in terms of your stocks to what's happening in terms of your cross-asset perspective. And I wanted to go to commodities because really we had Ed Morse, the Citigroup, on just talking about how we could move into a surplus in the oil market come 2023. And oil actually on the downside today is that as they too eye what the Federal Reserve might do. What does that mean for global growth? What does it mean for US growth? What does that mean for demand for oil? We see WTI crude actually giving up gains, but remember it's still above $80. In fact, at $81.45, went down by a percentage, 1.44%. We see Brent crude giving up about a percentage point as well. Natural gas, absolute volatility here, of course. As we saw yesterday, natural gas prices spike about 13% on the back of the cold weather that we're experiencing here, and particularly the northeast of the United States. It's now plummeting back down 12%. So make of that what you will in terms of our on again, off again moves into natural gas. I'm looking at what's happening in terms of foreign exchange. In sympathy with oil falling, Norwegian krone goes down by 0.6%. I don't see it here, but the Bloomberg Dollar Index basically flat, but in fact down for 3 straight days now, the worst 3-day sell-off in the Bloomberg Dollar Index that we've seen since back to May. Therefore, on the flip side of that, you see a little bit of buying in the yen, up about 0.4%. Swiss franc also getting a bit up, some 0.3%. But Taylor, once again, buying across the sovereign bond market at the moment, from Italy to Portugal, the 30-year debt getting a bid. So long-term and also short-term debt, the Spanish 2-year yield down some 4 basis points.
Yeah, you're really seeing the bid for the safe haven come back into play as bond yields are showing that that is their role within these markets. You're down 3 to 5 basis points pretty much across the curve. But what is, I think, interesting, Carol, as we think about all this week, a Federal Reserve that's continued to talk about 3 to 4 rate hikes, a QT and a big shift from QE, and long-term perspective, the range-bound nature that we've been in. Still, so far, that long-term trend line has been higher. All the analysts that we've spoken with, Jim Paulson, Kevin Nicholson, for example, on TV, have said that, yes, the path is going to be orderly, but it will be higher from here.
Well, and the only thing I would throw on it, and, it's been such an interesting week. I'm a little exhausted, a lot of Fed speakers, but, this kind of, they've really come together. We know we're anticipating that they're going to raise rates, guys, but I do wonder if any way that what we hear from CEOs, could that change kind of the psyche within the financial markets in terms of the outlook?
I think the short answer to that is certainly it could. I guess the question is, what do we actually hear out of them? We've actually seen some revisions already from some companies basically kind of front-running this, saying, hey, tamp down your expectations just a little bit. But, of course, we also saw, there was a lot of pessimism going into a couple of the quarters last year, and a lot of companies really knocked it out of the park, or at least were able to reassure investors that everything was okay.
We heard from Richard Weiss over at American Century Investments a little bit earlier on TV talking about Omicron. I mean, we sort of have put it to one side on days such as this, where we really focus in on what the Federal Reserve is doing and talk about inflation when you get a PPI reading that's still so elevated. But Omicron, what does that mean for future supply chains? What does that mean from some of the executive conversations we get over the next few weeks over earnings season?
I'll take the flip side of that trade and say that this is a Federal Reserve that has said we can't solve those supply chain issues. We can solve a demand problem. Demand isn't the problem. And I think most of the analysts we've spoken to says, barring a huge, massive turn of events, this Fed knows exactly what they're doing the next 2 months.
But they got to get prices down. I mean, ultimately this is about, comes back around to inflation here, whether they actually have the tools to really tamp it down here. I mean, we saw, of course, the CPI report yesterday. We've seen retail prices for things like lettuce skyrocketing more than any other food item out there, Carol.
It's crazy. We just did that story. What was it up, like 60% something over year over year?
Lettuce. You've got to be specific about which type of lettuce we're talking about here.
You're absolutely right. So maybe we need to move to kale. But
that's one of the oldest varieties out there. You know, it was like back in the Byzantine era. It's like,
now that is a fact you should know, given your name.
First it's Goldilocks, yes, and then it's romaine. But you know, I do wonder about PPI, right? That print, maybe there's signs that things are easing, and I do feel like we're starting to get little tidbits of information about maybe when it comes to pricing, maybe when it comes to supply chains, guys, and Caroline, that things are starting to ease.
How about the labor market though, and indeed getting people back into the office amid Omicron? I mean, there's Supreme Court news coming out about an hour or 2 hours ago, really putting paid to some of that effort coming from a federal level to ensure that workers are forced to be vaccinated and get back into the workplace, but still companies are going to go at it in an individual way, and it seems as though President Biden is asking them to do so.
We're seeing it pretty aggressive on
Is anyone back in the office though? I mean, I was walking around Midtown yesterday after work, and I mean, it was a ghost town. No joke.
Do we count for anything?
Yeah.
All right, but we know things can bounce back quickly, so fingers crossed that we peak and we start to see people coming back.
And they come and buy their expensive salads.
Exactly, if they're there, right? All right, we got to run, guys. That's going to do it for Beyond the Bell. Our cross-platform coverage on radio, TV, and on YouTube. We'll see you again, same time, same place, talking bank earnings, no doubt about it, tomorrow.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser along with Katie Greifeld. She is in for Tim Stenovic. I am a little exhausted about all this Fed speak, Katie. I don't know how you feel about it.
Oh my gosh, me too. I mean, on a day or on a week where you have both Powell and Brainerd speaking, it was a lot of headlines. But man, I am just struck by this equity market action. NASDAQ 100,
Why?
lowest close since October on a day where the 10-year Treasury yield fell 5 basis points. I got to ask some sources what's going on.
Yeah.
What a move.
Yeah, you're right. Pretty significant. And I do think, there's some momentum building for maybe there's going to be some policy missteps and dislocations continuing longer than everybody thought. All right, let's get back to world and national news. Nancy Lyons, take it away.
Thanks, Carol. President Biden has spent the afternoon on Capitol Hill trying to map out a strategy for passage of voting rights legislation. Just before he met with the 50 Senate Democrats, one of the holdouts on revising the filibuster, Senator Kyrsten Sinema, took to the Senate floor to once again express her opposition.
When one party need only negotiate with itself, policy will inextricably be pushed from the middle towards the extremes. And I understand there's some on both sides of the aisle that prefer that outcome. But I do not.
Sinema says she supports the voting rights bills, but does not want to back a change in Senate rules that she says will worsen the underlying disease of division affecting our country. President Biden says with the Omicron variant of the coronavirus surging, his administration will double its order of rapid COVID tests to send out to all Americans.
I mean, 1 billion tests in total. And we'll continue to work with the retailers and online retailers to increase availability.
Biden says his administration will also be distributing high-quality masks to the public. Today, the Supreme Court ruled that the administration cannot mandate vaccines or tests for employees of large companies, but can require vaccinations for healthcare workers. Stuart Rhodes, the founder and leader of the far-right Oath Keepers militia group, has been arrested and charged with seditious conspiracy in the January 6th attack on the U.S. Capitol. The Justice Department announced the charges against Rhodes and 10 others today. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser along with Katie Greifeld. We are in our Interactive Brokers studio, and we are streaming on YouTube. And Katie, you're somewhere in our... I'm just kidding. You're at another...
Somewhere in the metaverse.
Yes, exactly. So this story by our Suzanne Woolley, and she really tracks a lot when it comes to consumer finance and consumer business news. And this has to do with Americans, how much money they say they need to earn to be financially safe.
These numbers are from the Personal Capital and Harris poll, and you need to be earning six figures. The number came in at $128,000, and the median household income in 2020 was $67,521. So there is a lot of daylight between those two numbers, Carol.
Yeah, exactly. That's huge. And I feel like it gets to the bigger story that we've been talking a lot about the gaps between those that feel financially secure, and it tends to be people who own a home, who are in the financial markets, and then those who are not. So the survey, it was of more than 2,000 people, did find Americans with, quote, a dwindling sense of financial confidence. In 2021's final quarter, 34% of respondents and they felt financially healthy, compared with 48% in early 2021.
And of course, I mean, as we've been talking about, this is in an environment where inflation is rising rapidly. Yes, you do have wages rising as well. Not enough to keep up with inflation, though. So a lot of people are actually seeing, real wage growth in the negatives. And this stat caught my eye, too, that nearly half of those surveys said that their debt is unmanageable, that at this point, 37% that a surprise $100 expense, that would make them anxious.
I remember talking about this a lot, Katie, during the pandemic, like in the early days, and some of these numbers were coming about that people who were like, I don't even have a few $100s in the bank if I had to do a quick fix on my car or what have you, that it's just not out there. So it really is a sign of the times. All right, you are listening to Bloomberg Business Week. Quick headline: crossing the Bloomberg, Alphabet, Meta, Twitter, Reddit, subpoenaed by the January 6th riot panel, probably looking for some information on social media.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market was lower today, and we finished near the worst levels of the day. The big risk seems to be the possibility of the Fed being behind the curve when it comes to inflation. Today, we heard a number of Fed officials addressing this concern, including Chicago Fed Bank President Charlie Evans. He was saying monetary policy simply isn't positioned to deal with surging inflation. Now, today's reading on PPI was very tame, I'll grant you that, but remember that big spike yesterday in the CPI report. We also had hawkish commentary from Fed Governor Lael Brainerd, who at her confirmation hearing today was saying tackling inflation is the most important task. The Dow Industrial Average today down 0.5%. A lot of weakness in technology today, with the S&P down 1.4%, and in the NASDAQ market, the composite index sliding 2.5%. Short while ago, we learned the House Select Committee investigating the January 6th attack on the Capitol has issued subpoenas against a host of tech companies, including Alphabet, Meta Platforms, the parent of Facebook, along with Twitter and Reddit. In the bond market today, curious move in yields. We were down across the board. 10-year Treasury losing 5 basis points, last quoted at 1.69%, and the 2-year Treasury down nearly 3 basis points to 89 basis points. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, good stuff. Thank you so much, Doug Krisner there with a Bloomberg Business News Flash. Well, our next guest has come to our program a few times over the last couple of years, and it is a really great time to talk with him because I think we continue to see how we work, where we work, continue to evolve. Back with us with a special report about the company's Microsoft Work Trend Index is Jared Spataro. He's Corporate Vice President at Microsoft 365, and he's back with us. He's on the phone in Redmond, Washington. Jared, nice to have you back with Katie Garfield and myself. So how are you?
Doing great. Thanks for having me back. I'm excited to be here.
Well, we're excited to have you here, and I love this report because you guys, collect so much data and really have a great view in terms of really how people are truly working. Tell us about the latest update on the Work Trend Index. Who you surveyed, what you found out, what time frame. Give us all the background on it.
Well, our research here at Microsoft is historically focused on what we call information workers. So those are the folks who work at a computer and who often have been working remotely over the last 2 years. And we decided it really was time to focus on frontline workers. These frontline workers have really shouldered a lot of the burden over the last 2 years, and they have not been able to go home. And so we wanted to find out kind of what was happening with them, how they were dealing with it, and how work is changing for them, and what would be the lasting trends.
And what stuck out to you in the results that you did find? And I'm curious how that compares to, surveys that you've done with office workers.
Yeah, let's take a step back for a moment. There is really unprecedented stress in the system when we think broadly about business markets right now. And nearly every single business is facing kind of the same challenge. And it's how do they continue to drive business results and serve their customers, but at the same time balance that with employee well-being and growth. And I think that's really what stuck out to us, is that as we look at this group of folks in all sorts of different types of roles, it's the people who couldn't go home, they have done so much to keep business running, but in many ways they are feeling a bit afraid about the edges. So, for instance, if we hit some of the data just right out of the gate here, to weather the storm, it looks like these frontline workers have really turned to each other. We learned that 76% feel very bonded to coworkers because of the shared stresses that they've endured during the pandemic. But at the same time, they're starting to feel a bit of a distance between the work they're doing and the rest of their company. 60% of frontline workers say that leadership doesn't seem to prioritize culture, and communication isn't reaching them. And so they're kind of feeling a little bit like they're on an island right now. And it's not so surprising to know that they were kind of bonding together, but that feeling that they're kind of off on their own, we think that's something for business leaders to take note of.
Well, it's so important, too, and you remind us, and you kicked it off, but 80% of the global workforce, that's our frontline workers. So we're talking about those that are working at supermarkets, obviously healthcare, but so many of those individuals who kept so much going for all of us, especially at the height of the pandemic. Here we are at, other peaks, but kept things going because they had to and they couldn't do their jobs at home.
That's right. There are 2 billion, more than 2 billion frontline workers worldwide. They really do form the backbone of economies in just about every country. And for this particular survey, Carol, we went out across 9,600 frontline workers in 8 industries and across 8 countries. So our definition was you had to be doing all your work in person. It's a very broad definition, as you indicated. It included healthcare workers all the way to grocery store clerks, included people, for instance, who are on the front lines in a manufacturing facility, all across that. And we're just trying to get a sense for, what's going on and what are they experiencing.
And Jared, you mentioned that it feels like they're experiencing this growing gap between the workers who are bonding with each other and actual management, that 62% say their company doesn't prioritize culture. I mean, is management aware of that?
Well, that's the thing. We do think that managers are very aware. I mean, we have a lot of empathy for what's happening here because that's the balance that companies are needing to kind of strike. They have to continue to serve their customers, so they recognize that that's a present demand on them. And at the same time, now they have to kind of balance the well-being and the learning and growth of these employees. So it's a hard task, to be very clear. And what we found is if you look at the center, kind of let's call it the corporate managers, they very much understand that there's an issue, but I don't think that they've always had a great deal of visibility into exactly what's happening. One really interesting difference between this and the IW, the information worker research that we did previously, we found that these frontline employees and their direct managers, who also tend to be frontline employees, so someone, for instance, in the store managing with them, that they are very close. In fact, there's a lot of closeness there, and those frontline managers really understand the issues.
Hey, listen, just got about 40 seconds, then we'll come back and chat some more, Jared. But I mean, what surprised you most in kind of doing this survey? And you and I have talked certainly around the, on air about the IT workers. What was the thing that was really just stood out for you in the difference?
Well, here, I think one of the things that surprised me the most, that happens to play into what we do, is that these frontline workers say that technology can make a really big difference. There's been a lot of discussion about whether technology is good or bad for the frontline. We found that a lot of them said they think that it could make a huge difference in how they do their work.
All right, we're going to come back, continue, because there's also some interesting results that came out when it comes to supply chain issues, which I feel like is obviously so relevant to what we talk about here at Bloomberg. We're going to come back with Jared Spataro. He's Corporate Vice President at Microsoft 365 on the phone from Redmond, Washington. What's been really cool, Katie, and we've talked with Jared a lot, is just, they really, especially when it came to IT workers, but it's good to get this insight on the frontline workers, but they, have so much data in terms of how people been, using their IT.
It's really cool to get the frontline perspective, especially after we talked with Kurt Wagner about how there's a lot of discontent at Facebook, at these tech companies, too.
No, it's a really good point. You're listening to Bloomberg Business Week. Carol Masterlaw and Katie Greifeld, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, Katie, we're almost done. I don't know about you, but I am so ready for the weekend.
Me too, especially because it's a long weekend. Can't wait. But I am excited to get back to Jared Spataro, especially because we've been talking about how stressed out frontline workers are.
Yeah.
Love to know how we make that better.
Yeah, it's a really good point. We're going to get back to him. He's Corporate Vice President over at Microsoft 365. First up, though, let's get back to Doug Krisner with a check on some of the news after the headline. There's just a lot going on, Doug.
There is a lot going on. You want to begin with after the bell news? We're
Please.
told that StubHub Holdings is exploring the possibility of going public via a direct listing. How's that? So today in the equity market, we finished near session lows. It was kind of a curious day because we started on a very positive note with a benign reading on wholesale inflation. PPI was up just 0.2% last month. That was half of what the market was expecting. But as the day went on and we began to hear from a number of Fed speakers, I think this idea began to coalesce that maybe the Fed is at risk of being behind the curve a little bit when it comes to inflation. Chicago Fed Bank President Charlie Evans was saying monetary policy isn't positioned to deal with surging inflation. Put that PPI report aside. Remember yesterday's spike in CPI? That a jump for all of last year of 7%. I guess we could debate this notion of it being transitory or not, but for the moment, a little bit of anxiety. Look at what happened in the bond market today. Long-term interest rates fell. In fact, yields, the entire yield curve really shifted lower. 10-year Treasury 169, down nearly 5 basis points. A 2-year at 88 basis points, down nearly 3 basis points on the day. So a little bit of risk-off appetite. The dollar wasn't a big beneficiary, kind of flat here at the end of New York trading as we get set for trading in Asia. The Dow today off 0.5%, S&P down 1.4%, NASDAQ comp, a lot of tech weakness today. It was lower by 2.5%. I'm Doug Krisner. That's your Bloomberg Business Flash.
You sure you got it all in there?
I tried.
It's a lot. All right, Doug Krisner, thank you so much. Still with us is Jared Spataro. He's Corporate Vice President of Microsoft 365 on the phone from Redmond, Washington, a special report that they've got, their work trend index, really looking at those frontline workers, and he's been talking with Katie and myself. Hey, one of the things in the report you do tackle are supply chains, and there's a lot of those frontline workers who were surveyed. They feel that more could be done to help those issues. Talk to us a little bit more about the findings there, Jared.
Yeah, you bet. If we take a step back for a moment, just to get a sense, put ourselves in the shoes of a frontline worker, 51% of folks who are in non-management positions don't even feel valued as employees right now, and that's just again
that's terrible.
That they're having
that's
to
crazy.
bear. Yeah, it's tough. And then as we move to the point that you were just making about supply chain issues, 52% of them say that they feel like more could be done. So there's just there's a lot of stress in the system. Again, there's a lot that can be done. We think it's a really important time, but I think knowing what's going on is half the battle. It gets us started on the right foot.
Hey, Jared, how do we make this better? Because before the break, you said that technology can really make a difference here. Walk us through that, and how does Microsoft play a role in that?
You bet. Well, we have, coming out of the report, we have 3 different recommendations. The first is to prioritize culture and communication. The second is to really focus in on those frontline managers we mentioned a few minutes ago. And then this last one is technology. We were really heartened to see that technology ranked very high on the list of things that could help. 63% of frontline workers were excited about job opportunities that tech creates. And technology ranked 3rd on a list of things that they say can reduce stress. It was behind more pay and vacation, not surprising, but it was ahead of mental health and well-being benefits. So there's this really great opportunity we think we have if we'll take a moment, recognize what's going on, really lean into these frontline workers with a lot of empathy and understand how we can help them and use technology to implement our plan. So that's kind of one of the big findings coming out of the study.
Jared, what are the conversations you guys are having at Microsoft? You just talked about technology, and I do think about there might be certain parts of our world, despite it feels like tech is everywhere and has evaded kind of everything that we do, and in many ways made it easier, more functional. But I do wonder about these frontline workers, whether it's supermarket workers, healthcare. Increasingly, we see a lot more technology continuing to go into that area. You know, have there been things that you guys say, well, wait a minute, here we are, Microsoft, here's what we can do specifically to kind of change how these workers work and improve the situation?
The whole idea behind technology in a case like this is to empower the individual, and that's really what we're all about. What we want to do is to give them the information, to give them the decision-making authority, to help them do their jobs better. Everybody feels good when they can do a good job. And again, if we look at what the data says, a third of these frontline workers say that they just don't have the right technology to do their job. So simple examples can help. As a simple example, some of the things that we've introduced include a walkie-talkie function that is a part of what we call Microsoft Teams now. That's an app that you can run on your mobile device if you're a frontline worker. And, you know, maybe in a retail store you have seen that before, where someone's able to tap a button on a headset and talk to all of their colleagues around a store to ask questions. That may seem like a simple thing, but that communication goes a long way. We also have done some really great work in what we call shift integration. This allows you to use technology to coordinate when you're just going to work. When is your shift? And if you have problems with that shift, can you actually switch it with someone else so that you can work Wednesday evening and they can work Wednesday morning for you? So those types of things seem small, again, because the information worker population, a lot of what's happened is their world has been digitized. As we digitize what's happening with frontline workers, we just bring an incredible amount of empowerment to them.
And Jared, what are the hurdles when it comes to adoptions? I mean, how much training do some of these programs and these apps require?
Well, the idea is to make it so that technology requires little to no training. And this comes from the fact that we can see in everyday life, in our consumer lives, the technology we use often is so easy that it's just something we pick up. However, we do hear from frontline workers that they've been given technology that either isn't simple enough or where they definitely need training and they don't get it. Over half, 55%, say that they've had to learn this new technology without formal training. So one of the other implications of the study is, as we do all of these things, make all these changes, including introduce technology, we really need to rethink skilling and learning on the job. We think that the way to go is what we call just-in-time skilling, where right at the moment when you need it, you get the training in small bite-sized pieces as opposed to some big, long training course you have to take.
Jared, just got about 30 seconds here, 40 seconds left here. I do think about our Bloomberg audience. I'm always thinking about an investment perspective in terms of anything and everything we do or how it impacts our economic growth going forward. Just your final thoughts, maybe with that in mind. And again, just got about 30, 40 seconds.
You know, a strong front line means a better bottom line for every company. And so we actually think, though these numbers look bleak on the surface, that it's an opportunity for real leaders to stand up within their industries and companies, lean into this, create an awesome environment for frontline workers. And again, we think that's going to translate into the bottom line.
All right. Always good to get time with you. Jared Spataro, Corporate Vice President over at Microsoft 365, on the phone from Redmond, Washington. Jared, by the way, will be participating in our work shifting event that's coming up on March 9th. For more information about it, please check out BloombergLive.com, because a lot going on here in our third year of the pandemic. Katie, that's one thing I just can't get my head around.
I know. And I think about like the last time I went to the movie theater. I left the country. It's been a while, Carol.
Yeah, exactly. Even just, feeling comfortable going out for dinner. Mm-hmm. All right, let's get back to world and national news. For that, Nancy Lyons in our D.C. studio. Hi, Nancy.
Hey, Carol. The Supreme Court has blocked part of President Biden's guidance on dealing with the pandemic. The justices blocked the vaccine or test rule for large businesses, but they are allowing the vaccine mandate for most healthcare workers. Well, President Biden is taking additional measures to combat the virus, which continues its severe impact on the unvaccinated and the hospitals that treat them.
The president said 1/3 of Americans are ignoring the guidance to wear a face mask indoors, so masks will soon be made available free of charge. In addition, I'm announcing our next deployment of 6 additional federal medical teams, a total of more than 120 military medical personnel, to 6 hard-hit states. I'm directing my team to procure an additional 500 million tests to distribute for free. I mean, 1 billion tests in total. The president again pleaded with social media to screen out COVID disinformation. In Washington, Irv Chapman, Bloomberg Radio.
The top Republican in the House is defending his refusal to testify before the committee investigating last year's attack on the Capitol. Minority Leader Kevin McCarthy says he does not believe sharing his conversation with President Trump from that day would add much to the investigation.
There is nothing that I can provide the January 6th committee for legislation of them moving forward. There is nothing in that realm.
The committee today issued subpoenas to Twitter, Meta, Reddit, and YouTube demanding documents. And the Justice Department leveled sedition charges against more than 10 leaders of the far-right group, the Oath Keepers, who were at the Capitol. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masterlaw, Katie Greifeld, she's in for Tim Stenovic on this Thursday. We're live in our Bloomberg Interactive Broker studio. We are streaming on YouTube. And Katie, we've talked a lot about the markets, and we did see some significant moves, certainly when it comes to tech names. NASDAQ 100 sinking 2.6%, its lowest close since October. And there seems to be some concerns. We know we're going to see earnings growth overall in the S&P 500. I think Gina Martin-Adams of our Bloomberg Intelligence team has talked about 20% plus or so, or give or take a little bit. We'll see earnings, but I think there's some concerns, especially too for those tech earnings. It's not going to be as dynamic as it's been.
Yeah, Carol, like you said, at the index level, I mean, things still look pretty rosy. But if you look at the tech sector, and again, that is the biggest sector by far, some of your mega caps there, looks like some of the group's specialness is diminishing. This story just hit the terminal. So if you look at income growth for some of those huge tech companies, it's actually forecast to fall below the broader market's rate into the end of the year. And I mean, Carol, tech, those are your growth stocks. So the fact that, okay, actually income growth is slowing, you're not going to get any of it there, that's a bad sign for this sector.
So here's what we've got. Our Bloomberg Intelligence data, what it's showing is for the fourth quarter earnings season reports which start coming out this week. We know we're going to get the big banks, but we'll start to get all the sectors, including technology, expected to post slower growth in the S&P 500 overall. 15% versus 20%. That's data compiled by Bloomberg Intelligence. So that's the concerns. But we've seen the valuations, right, really creep up higher, especially when it comes to big tech.
Yeah, and you layer this on top of the fact that yields are rising, interest rates are set to rise. It all adds up to a, not as bright picture for tech. But I mean, Carol, it feels like we've written the obituary for tech time and time again. It always bounces back. We'll see. You do have some different elements here in that, the Fed hasn't lifted rates since 2018. So a little bit of a different environment.
And they're raising rates, but it's not going to be like off the charts. The other thing is technology is such a big part of our world, right? Whether it's at work or play, it's a big part of our economy. So I kind of get the enthusiasm we've seen in the financial markets.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Stock market was down today, and the major indices finished at session lows. NASDAQ Composite and the NASDAQ 100 were each off 2.5%. We had a rough day for the EV makers. Tesla off 6.7% today, and Rivian Auto was down by more than 7%. So the day began on a positive with a very tame reading on producer prices, but as the day went on, a number of Fed officials, including Chicago Fed President Charlie Evans, addressed this idea of inflation. And Evans said that monetary policy simply isn't positioned to deal with surging inflation. There were hawkish comments from Philly Fed President Pat Harker, and Governor Lael Brainerd during her confirmation hearing today said tackling inflation is the most important task. So we had the Dow losing 0.5%. In the broader market, it was the S&P down about 1.4%. Now, on an otherwise down day, Biogen shares were up 5%. This was after the publication Stat reported Goldman Sachs has given Biogen a list of potential buyout targets. Delta Airlines today up 2%. The carrier saying the worst of Omicron is behind us and the virus will not derail Delta's expectation to remain profitable for the rest of the year. And StubHub Holdings is exploring going public via a direct listing. In the bond market, 10-year Treasury last quoted at 170. We were down more than 4 basis points in yield, and a 2-year down more than 2.5 basis points at 89 basis points. I'm Doug Krisner. That's your Bloomberg Business Flash.
Hashtag optimism, Delta, right? Gotta love it. All right, Doug, thank you so much. Well, great to have back with us Mitzi Perdue. You might recall from when she was last on, she's the daughter of one family business. We're talking about her father who founded the Sheraton hotel chain. Her late husband was Frank Perdue of Perdue Farms, and she's written about family businesses. She's also written about her late husband, the Frank Perdue Way, Simple Steps, Super Success. She's also the founder and chairman of Win This Fight, and she's back with us on the phone in Salisbury, Maryland. Mitzi, nice to have you here. How are you, and how have things been going?
Well, first of all, I'm absolutely delighted to be back. And second, how things have been going. Since we've talked last, I've written 3 books.
Wow, you've been busy.
Well, it's all because of, I mean, it's the silver lining to something really horrible, the COVID. But being home and no distractions, that's what I've been up to, and very happy doing it.
Well, Mitzi, let's hear about one of your latest books, The Frank Perdue Way, Simple Steps, Super Success. What are the takeaways there? Obviously, this is about your late husband, Frank Perdue, the of Perdue Farms.
Yeah, the chicken man. And yeah, I did write this book. It's interesting how it came about. There's a publisher who's done business titans like Disney and Carnegie and Hershey, and she wanted me to do something on him. So I thought, oh boy. But her particular specialty is very short books, like 60 pages. You can read it maybe in an hour. But I tried in writing this book, I thought I would extract from Frank's life what would be most useful to people who wanted to make the most of their lives. And what the point of the book is I tell stories and then I tell things that you learn from them. And I'll give an example of the kind of things that you learn from Frank. One of the ways that he went from having no employees to having 20,000, and I'm going to share with our listeners something that they can do, was he was extraordinary at listening. I used to notice that whenever I was with him, whether it was, I don't know, a board meeting, a sales meeting, just talking with somebody in the street at a party, he would listen 90% of the time and talk 10% of the time. Isn't that cool?
You know, we don't do that enough. And I don't mean we, me and Katie necessarily, or
on
you,
this
Mitzi.
program.
No, but it's so true. You know, how often we're in a conversation and you feel like everybody's not really listening, but just getting ready to think about what they want to say, rather and what gets missed. Do you think he was a good listener, Mitzi, because he was an introvert, which you also include in this writing?
Yeah, he was. He felt that that listening to people meant that you could learn a lot. And, you know, one of his mottos was, none of us is as smart as all of us. And, you know, another thing in the subject of listening, if he'd go into a sales meeting or any meeting of people who worked with him, he made it a point, and I got to watch this, where, say there's a problem, he would not make it obvious what answer he wanted. His goal was for the people in the room to own their solution. And so I bet you've experienced that you're in a conference room and you know what the boss wants, and everybody twists into a pretzel to try to say what the boss wants to hear. Frank made sure that didn't happen. And again, you know, this is something that he told me over and over again. He'd say, there's a lot of intelligence, a lot of experience, a lot of just smarts in this room, and my job is to tap into it. And so he was careful not to kind of short circuit the project by having them know what he wanted. And again, I just thought that was an amazingly cool thing. And if I could add one more, I mean, try and stop me.
No, please, we're listening because we're really enjoying this. So go ahead, please.
Oh, thank you, thank you, thank you. I mean, it's rude to monologue and I'm guilty, but here goes.
All good.
Something else that he did that anybody who is a manager, I think, could benefit from this. When he'd enter a room, you know, he's the alpha male. He's the person who's, you know, the boss of 20,000 people. He's the person whose name appears on everybody's check. But here's what he'd do, and it has to do with body language. And I love to study body language, and I'm a writer, so I notice these things. When he'd walk into a room and he's trying to tap into the intelligence in the room and get everybody talking and, you know, showing off their best ideas, he could have walked in, you know, taking up all the, what I call taking up all the oxygen, you know, standing tall, chest out, great big gestures, but he didn't. No, his gestures were kind of small and almost shy, and he had good posture, but it wasn't a strutting kind of posture. He was really kind of, from a body language point of view, signaling, hey, I'm one of you. Right. We're part of the same team. And again, I just thought that was such a wise approach, and I haven't personally seen any other leader do it.
And Mitzi, before we go, I do want to hear a little bit about you, because you are chair of Win This Fight. It's an organization that combats human trafficking, obviously a very important topic. I mean, what are you working on right now with that organization?
And just got unfortunately, about 40 seconds left here, Mitzi.
I'm a little bit separated from it because we went different ways. Management of it decided to go after money laundering, which I endorse. But what I think my whatever gifts I have, they're more in the nature of writing and speaking. So I've written more than 100 articles for organizations like Psychology Today or Wealth Management, and then I've been writing books. So writing and speaking is what I've been doing most for combating human trafficking.
Well, and I know we've talked about that before with you, so we appreciate you weighing in as well. But really fun to talk about some, as you say, the Frank Perdue way, and you put it in this little book, and it's really fun to kind of go through some of those things. Mitzi, thank you. Mitzi Perdue, Sheraton Hotels heiress, as we mentioned earlier, joining us on the phone from Salisbury, Maryland. Do you want to mention a headline crossing? Jack Dorsey tweeting, "We're officially building an open Bitcoin mining system." How about that, Katie?
Feels like a matter of time. Dorsey, he's all in on crypto.
I love how everybody's like just jumping on the bandwagon, right? It feels that way.
Yeah, definitely.
All right, kiddo. Hopefully we can have you in studio tomorrow. Fingers crossed.
Fingers crossed. In any case, nice to see you on the screen.
Same here. Always, always. Have a good evening, everybody. This is Bloomberg.